Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Re-rating rate bets, global stocks retreat, as surprisingly strong US services data fuels concern the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an 8th consecutive month and warns there is more to come. The Aussie dollar climbs. Plus, the US and EU, they're said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity.
Tom, let's look at the futures. For the moment, we're seeing a bit of pressure on the FTSE, down 0.2%. Similar loss for the European stocks, 50 overall, down 0.3%. They're really following what happened in the US is after some disappointing data in terms of US service data, and actually unexpectedly strong. So that's fueling bets for more hikes from the Fed.
Yeah, it's the good news on data is bad news for the markets theme that is coming through. We saw the losses across European equities yesterday, 3 days of losses for US markets. And in terms of how we position, it is the question around the terminal rate once again. So the strong non-farm payrolls and then the strong services data, as Francine was saying yesterday, out of the US, just readjusting and leading to a rise in terms of the forecast for the markets as to where the terminal rate ends up. Plus 5% now is what the markets are expecting. The FTSE 100 currently down 0.2%. Over in Spain, losses of 0.4. France down 19 points, and Germany, the DAX, is off by 0.3%. We had the ECB's chief economist as well coming out saying we are close to peak inflation, but further rate increases are in line. And we, of course, have that meeting, that decision by the ECB in about a week and a half's time. Let's switch it on and have a look at how things are playing out across these sectors then, as the losses continue in Spain, now down 0.5%. The futures in the US just pointing very modestly. It's range-bound, essentially, again, after 3 straight days of losses. We'll see if that holds. The yen is in focus for us today because it's come under pressure. 136, just below 137, on the back of a slightly stronger US dollar. Just a 0.2% move lower for the Japanese yen, actually after a few days of gains for that currency. Again, the rate differential between the BOJ and the Fed back in focus. The 10-year, 3.59, after that jump in yields yesterday on the back of stronger than expected services. Got to 3.60, currently just below that at 3.59. Just a move of 2 basis points. Brent, $83 a barrel. That is a gain of 0.9%. The last time I checked, WTI was below $80 a barrel. Francine.
Now let's dig deeper into the sectors. Out of 19 groups that make up the Stock 600, I have 5 on the upside, and that's basic resource, utilities, telecoms, auto parts, and food and beverage. Energy, real estate, and financial services are the biggest losers, down some 0.5%. Now let's bring in Bloomberg's Valerie Teitel, who's looking at another equity market rally that's now in doubt. Valerie, this is after the BIS, the banks of banks, the central banks of central banks, it has a huge warning.
Yeah, Francine, look, we've had now a string of stronger data coming out of the U.S. It started with the payroll print on Friday, but that wasn't enough to convince the market. We needed the strong ISM as well. And finally, we've seen the terminal rate nudge ever so higher. It's now just above 5%. And with that, the equity market has fallen. Again, we have this narrative play out again, where we have these peaks in the S&P. It's really bounced from the lows as the terminal rate stalls. But as soon as we get another glimpse that the U.S. economy is stronger than we expect, yet again, we have the equity market falling and the terminal rate rising. And now we look to the last data print we get before the Fed meeting is Friday's PPI. After that, we have the Fed then meeting next week. Well, they're going to release their summary of economic projections. And Francine, the key thing there is where they put the dot for next year, the 2023 dot, which essentially is the terminal rate. We only get these projections 4 times a year from the Fed, so the next one after this won't come till March. I think this is going to be a really key thing the market's going to focus in on is, will that 2023 dot be substantially higher than 5%?
Yeah, really interesting. The last dot plot, of course, 4.6% was the call there, but all the officials have been coming out suggesting it is going to go high, and certainly that's what the markets are expecting. But as you say, Valerie Teitel, will it be, and how much will it be above 5% if it does indeed come in around that level? Valerie Teitel breaking it down for us in terms of the implications, of course, for the terminal rate and the reaction function from the Federal Reserve. Now, unexpectedly strong US services data has added fuel, as we said, to traders' bets on just how high Fed rates will go. Very pleased to say that we are joined by Goldman Sachs' co-head of EMEA Global Investment Research, Sharon Bell, this Tuesday morning. Sharon, good morning. Thanks for joining us. Your take then, stronger than on-farm payrolls, stronger services data. Can the Fed really make a move down to 50 basis points in December?
Look, I think the Fed can slow down because they've been doing such steep rises in recent months. But I think that they are facing an economy which doesn't look like it's collapsing soon into recession. In fact, if anything, the risks are slightly on the upside to growth projections, I think, at the moment. So given that, and given that inflation is quite high and it's still above their target, they certainly want to slow the jobs market in particular, given that wage growth is relatively high in those latest figures. The service sector looks strong. I think, yes, they will slow things down, but they've still got more rate hikes to go. Of course, it's difficult because they're now dealing with an economy which has got different slices of it. You mentioned the labour market and the services, which look strong, but the manufacturing side of the economy has weakened. The housing market has weakened too. So I think they are faced with some more difficult decisions.
What's the most difficult decision, Sharon, that they have to take in the next 2 to 3 months? I know we're looking at suggestions that we have reached peak inflation. What if we haven't, especially because of a much colder winter in the US?
Yeah, look, inflation forecasts in the very near term, I think you can the crystal ball tends to be quite good in the near term when it comes to inflation. You can see things like commodity prices have come down off their peaks, for example, freight rates have come down from their peaks. We would expect inflation to soften a little bit. But in the sort of more medium term, there could be reasons why inflation goes back up again. Globally, if weather gets colder, you'll see gas prices, electricity prices, energy prices generally go back up again. Wages as well, that tends to be a more slow-moving part of the inflation jigsaw puzzle, but that's still high, if anything climbing. The labour market is tight in the US, that's still going to be quite inflationary. So while there are bits of inflation that are coming down, there are also bits of inflation that remain quite sticky.
Sharon, I want to name check some of your other colleagues at Goldman Sachs with their survey of money managers, suggesting that there is a tilt now to cyclicals, a suggestion that money managers are betting on a soft landing, that the Fed can engineer that. Is that looking rational for you at this point?
I think the Fed could well engineer a soft economic landing in the US. The problem is there's a lot of risks around that soft economic landing right now. And I'd be surprised if the market would be truly confident in pricing a soft economic landing when you've got all these risks, when you've got quite a tight labour market, when you've got a Fed that's still tightening. Perhaps it's slowing down the pace of its tightening, but it's still going through a tightening cycle. When you still have that manufacturing sector, which has come down very significantly and could come down further. So you've got, I would say, a really close call as to whether there is a recession or not. And cyclicals bouncing, I think, is a little bit premature.
We talk a lot about, Sharon, what's going on in shadow banking or currency swaps and things like that. Do you worry that there's a financial crisis in the making elsewhere than in banks?
Yeah, I think that's a great question because the bank sector, they were the ones that suffered during the financial crisis in terms of their loan losses were high. They had to rebuild their capital over a number of years. You saw really a lot of the pain and problems come through the banking sector in the last crisis. But this time around, banks, they're very stress tested, they're very highly regulated, their capital levels are high. That doesn't mean, of course, you won't have problems in the banking sector, but it reduces the probability, I think, of big problems in the banking sector. The finance industry, though, is broader than just the banking sector. We've seen problems in crypto, for example. We've seen problems in the UK in the pension industry with the LDI problems and the volatility in the gilts market. it's very difficult to know where these problems will arise. But what you do find is when interest rates go up as steeply as they have, and when economic growth comes down, then you are likely to see some problems arise. I don't think it will be systemic, and I don't think it will be as big as in the financial crisis. And I do think, crucially, and the banks are obviously incredibly crucial for the whole financial system, I think the banks are much better capitalised now.
Okay, you don't see a systemic risk, but it is worth monitoring those non-financial, non-bank risks. There's a viewer question come on, Sharon, saying, and the question is this: how would you expect a harsh winter in the EU to impact the policy and particularly asset allocation within Europe?
So I think if you've got a harsher winter, so Europe has really benefited. It's been in a lucky space in the last few weeks, month or so. We've had a mild winter so far, which has been great because that meant gas prices could come down. You didn't get a spike in gas prices in the way that people feared as you started winter. Germany has enough storage, which they built up over the summer. And China hasn't reopened yet, so it's not as big a competitor as it could be for global gas supplies at the moment. But as we go through this winter, I don't think China will reopen anytime soon. We don't expect until the second quarter next year. So I don't fear that so much. What I do fear is if the winter does get colder, clearly gas supplies will start to be used up. You could see a spike in some of these gas prices. You could see commodity prices generally going up a little bit. Energy prices obviously more broadly going up. So I think that the energy complex still remains incredibly tight. And it's something that could easily spike. So in terms of asset allocation, I feel that equities have bounced a little bit prematurely. I completely agree with the earlier analysis. People have now got a view that we're through the worst of the sort of rate hiking cycle. I think that is fair, but we're not at the end of the rate hiking cycle. With rates still going up, with growth still very vulnerable, with Europe still vulnerable to higher gas prices, if there is a colder winter, all of that in the mix makes me quite nervous about equity.
Sharon, thank you so much. Sharon Belder, Goldman Sachs, co-head of EMEA Global Investment Research, joining us this morning. Coming up, Chinese stocks climb as Beijing eases COVID testing rules. We discuss that next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game.
Welcome back to the Open, everyone. 13 minutes into the European trading day. This is a picture across the board. So a bit of pressure on European stocks. That follows also pressure on U.S. stocks yesterday. Unexpectedly strong U.S. services figures data actually fueling bets for a hiker Federal Reserve terminal rate. So we're seeing a bit of changes. And for example, a lot of commodities under pressure in today's trading session, Tom.
Yeah, and from one central bank to another central bank. I was thinking as well Australian commodities, because there's the linkages there as well as we look to China and the reopening. But Australia's central bank has raised its key interest rate to 3.1%. That's the highest level since November 2012. Bloomberg's Kriti Gupta has more. We've seen the Aussie dollar jump about 0.4% on the back of this news. Kriti, walk us through the significance then of today's decision from the RBA.
Well, the RBA has always been an early mover for central banks around the world. They were the first to tighten very aggressively. They're also the first to indicate some sort of slowdown. So this is going to be significant as we talk about the Federal Reserve, the step down that we're expecting to hear next week, December 14th, the big anticipated FOMC meeting. But we're dealing with a lot of the same problems. The RBA is dealing with a housing market that has been collapsing for 7 months now, while still dealing with pretty persistent inflation. We're looking at 6.9% CPI year over year. Now, I'm biased by the American numbers. It's not the same, but it's still pretty bad relative to the targets that they want. What that does is leave them between a rock and a hard place. And the idea here is if they start to choose to pivot or to slow down or to pause, does that for some reason kind of create a little bit of an experiment for the Federal Reserve, for the Reserve Bank of New Zealand, as well known as very hawkish? Do they then follow suit?
Yeah, and it was interesting actually to read the statement saying, look, the uncertainties mean that there are a range of potential scenarios. Is it so difficult? I mean, I know you're making linkages between the Fed. There are also a lot of discrepancies just because of the nature of the Australian economy.
Very different, and the commodity exposure is the key part of it. Remember, this is something that you've heard from the IMF, from the World Bank, especially when they talk about this kind of global slowdown. A lot of it was expected to start from the emerging market economies, not from the developed markets. And this is where Australia plays kind of a very different role, because they have more commodity exposure that's more in line with the emerging market universe than the developed market universe, as in they perhaps like set the price, for example, on copper or oil, for example, whereas the US or Europe or England is more a victim of it as opposed to setting the price. So very different story. I think the housing market story is the crucial one, though, because if you look at some of their other peers, their G10 peers, those housing markets are still in the bubble phase, if you will. This is where Australia is really different because they're already seeing that slowdown in the works.
Yeah. Is Australia the canary in the coal mine when it comes to the housing market after such a strong couple of years for that market? 7 straight months of falling prices, remarkable. Kriti Gupta, thank you very much on the importance of that RBA decision. Let's get back to what is happening with Chinese markets. Ties in, of course, to Australia and how they position around monetary policy. Chinese markets and assets sensitive to the nation's growth have reacted, of course, quickly as Beijing eases COVID restrictions. Goldman Sachs estimates that markets have priced in about 40% of the impact from a full economic reopening. Let's bring back then Sharon Bell, Goldman Sachs' co-head of EMEA Global Investment Research. And Sharon, 40% of economic reopening is priced in so far. The MSCI China Index already up about 35% since October. How much more upside do you see for Chinese equities?
I think that China equities can bounce a little bit more. I mean, we haven't had proper reopening yet. I think it's going to be a bit of a bumpy path, unfortunately. There'll be times where it looks like they have to scale back a little bit at that reopening, and then other times when they move forward with that. But I think over time, by the second quarter of next year, you will see China reopen. And at that point, then, yes, I do think there's a little bit more upside, maybe 10%, maybe a little bit more than that to the China equity market. It does look relatively cheap. It has spent some time underperforming, unsurprisingly, given the zero COVID policy that's been persistent in China for much longer than elsewhere.
Sharon, where do you find it? Are there any like commodity currencies or any commodity countries where you see value right now, or are you expecting, because of China and the reopening, or could there still be a correction further ahead?
Look, I do think I agree. China reopening is going to increase demand for all these incredibly scarce resources, commodities being the key scarce resource at the moment, along with labor. But in particular, commodities globally, they've been strong in the last year or so, but they have come off in the last few months. I do think China reopening will be part of what drives them back up again. We still have incredibly scarce supply of all these resources, and that is not changing at all. In terms of the markets or exposures that I think are quite interesting with respect to commodities going up, You mentioned emerging markets. Generally speaking, yes, I agree, it benefits emerging markets. But it was interesting you mentioned Australia. Some of the developed markets also benefit from higher commodity prices. And actually, interestingly, although the UK economy does not benefit from higher commodity prices, the UK stock market would. The FTSE 100 has large caps in energy companies, mining companies, and these are relatively inexpensive stocks versus the rest of the developed market universe, offering large buybacks and good dividend yields. So actually, I think it's a big benefit to FTSE 100.
Sharon, is that your preferred approach to getting exposure to China, then going via some of these proxies rather than directly getting exposure to Chinese equities and assets?
Yeah, I think it depends obviously on what universe you're tracking. And you can certainly buy, say, an MSCI EM or MSCI China as a route into investing in China. But there's definitely proxies for this globally. FTSE 100 is not a bad one because it's got a lot of commodity exposure. And it would definitely benefit from China reopening. Other possibility is just to buy a kind of slice of the European market with a lot of China exposure. There are companies with 30-40% of their sales direct to China. So again, you can buy Western companies, but with a big China mix as part of their sales. Or possibly the German market, the DAX as well. Because, of course, the big auto companies, some of the big chemical companies, some of the big engineers do sell a lot into China as well.
Sharon, thank you so much. Sharon Belder, Goldman Sachs, co-head of EMEA Global Investments Research, of course, joining us this morning on all things markets. Coming up, your movers, including Porsche as a German sports car maker, is set to replace Puma on Germany's DAX later this month. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Welcome back to the Open, everyone. We are 22 minutes into the European trading day, and this is the picture across the board. Now, if you look at the industries that are losing most, or the sectors that are losing the most, out of 19 groups, about 17 are on the downside. Only food and beverage and a couple of the retail stocks are up. But European stocks in general falling. Wall Street lower. We had some unexpectedly strong services data out of the U.S., and that's basically repricing some of equities and bonds, with traders making a bet that the terminal rate for the Fed could actually be higher than expected. Treasury yields, little change. The yen also reversing some of the gains after the Bank of Japan reiterated its dovish policy stance. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. The UK is said to be planning to announce measures this Friday aimed at boosting growth in the City of London. Sources tell Bloomberg the Treasury will sweep away unnecessary regulations on financial services in a bid to secure new post-Brexit opportunities and boost competitiveness. Two policies floated so far are the repeal of the banker bonus cap and adjustments to the ring-fencing regime. Taiwan's Honhai, also known as Foxconn, has reported sales for November down more than 11% from the previous year after shipments were affected by a COVID outbreak in central China. Last month's outbreak led to a worker exodus and violent protests at its factory in the city of Zhengzhou. The plant is where the bulk of the world's iPhone Pro handsets are assembled. Apple is being sued by two women who say its AirTag device make it easier for stalkers to track their victims. The small tags, about 3 centimeters in diameter, are intended to be slipped into or attached to personal possessions, like backpacks or keys, to help owners locate them. But privacy advocates have warned they can also be used to track people without consent. Apple, which advertised the AirTag as stalker-proof, didn't immediately respond to a request for comment. PepsiCo is reported to be laying off hundreds of workers at its various headquarters in North America. Dow Jones says the jobs will go in its beverage business based in New York and at its snacks and packaged food units in Illinois and Texas. PepsiCo employs about 130,000 people in the US and 300,000 worldwide. That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins here in London. Thank you very much indeed. Checking in on a couple of the movers for you, a couple of the individual corporate stories. Top of the list for me is very much Porsche. This is the news. By the way, it's remarkable. This company only listed this year. It is already the most valuable European automaker, listed automaker, and they will be joining, Porsche will be joining the DAX as of effective December the 19th, replacing Puma. Very different story for that company. Shares down 54% year to date for Puma. This is all about Porsche, though, taking over that spot on the DAX. That company gaining a little over 1% on the back of that. And then you have Saint-Gobain, of course, the building construction materials company. Reports that it could be looking to sell Jewson Builders and their material wood supplies here in the UK, possibly for about £1 billion, possibly to CVC Capital. Those talks continue. The deal could wrap up this week, is what we're hearing. And then Fresenius Medical Care, part of the Fresenius Group, they have had a change at the top of the CEO for Fresenius Medical Care over strategic differences. The CEO is only in place for a little over 2 months. The CFO stepping in to that CEO role. So watching that as well on the back of that executive change. Currently down 0.8%. Before we get to break, currently checking in on European markets broadly. The benchmark down 0.2%. Futures in the US range bound after 3 days of losses. Coming up, European Banking Authority Chairman Jose Manuel Campa. We're going to discuss Brexit at the City of London, regulations around the banking sector, risks in banking and off-balance sheet banking as well. There's a lot to discuss, an important guest around the regulatory framework in Europe. Stay with us. This is Bloomberg. DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Re-rating rate bets. Global stocks retreat as surprisingly strong U.S. services data fuel concerns that the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an 8th consecutive month and warns that there's more to come. The Aussie dollar climbs. Plus, the U.S. and the EU are said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity. Tom, what's it looking like on the markets? We've
got a second day of losses, at least so far in the trading session. European benchmark currently down 0.3%. Here in the UK, the FTSE 100 trading at 7,540. That's just a drop of 27 points. Similar losses over in Germany, also on the CAC as well. Futures in the US range bound after 3 days of losses there. As we've been discussing, of course, investors weighing up the good news versus bad news when it comes to US data. Non-farm payrolls came in stronger than expected on Friday, of course. Then you had the services data yesterday, just compounding the views that maybe the terminal rate is going to have to come in higher than 5%. They're likely, Sharon Bell of Goldman Sachs, still to step down their next decision to 50 basis points. It just means that the terminal rate may be higher. The implications then for these equity markets. Let's switch it over and see how things are playing out across the sectors. Just four sectors holding on to gains this Tuesday morning in Europe. Utilities gaining 0.2, so a bit of a defensive tilt there. Food and beverage just up a little over 0.1%, and personal products as well, just up 0.1%. Everything else in the red, led by energy, autos down 0.9%. The banking sector also taking a hit, currently down 0.8%, Francine.
Now, Bloomberg intelligence suggests that the threat of a recession, rising geopolitical risks, and a 50% increase in credit impairments may actually prompt more European banks to scale back their overseas presence. The analysis also suggests that European banks could improve profitability by focusing on domestic retail banking rather than seeking expansion abroad. Now, we're now joined for an exclusive conversation by the European Banking Authority chairperson. He's José Manuel Campa. Mr. Campa, thank you so much for joining us. There's so much going on in the world of banking. We talked about bonuses, dividends. First of all, it seems that the sector as a whole is pretty healthy. Can they afford buybacks and dividends?
Well, I think that, as you said, the sector overall is pretty healthy. The capital ratios are high. They're a 15% corrected Tier 1 ratio, which is kept high all throughout the COVID period for the last 2 or 3 years. So that's a good starting position. But of course, the macroeconomic outlook is also uncertain. And, you know, we're being telling banks that they need to be cautious and they need to be prudent in their projections going forward to make sure the capital trajectories are adequate for what looks to be like a worse outlook than we expected certainly a year ago.
So to be clear, you think they need to be a little bit more conservative. Would you lean on them to kind of hold back on buybacks and dividends given that we're heading potentially into a recessionary environment?
Well, we're asking them to be conservative, but I think the key point here is the individual discussion that the supervisors need to have with each individual bank, because the overall levels look good. Provisioning has been low so far. We think that they were likely to go up as the economic downturn materializes more and more. So therefore, banks need to make sure they're able to weather the downturn in an adequate form. So it's really a one-to-one discussion.
But where's the biggest risk? Is it outside the financial markets? So is it shadow banking? We have a couple stories on currency swaps, and could they actually infect and impact banks?
Yeah, in financial stability concerns, our biggest concern is precisely that. It's the non-bank financial intermediation and the fact that there's been a large amount of activity throughout these years that has, in the very high liquidity environment, that has moved away from banks. And so far, that has not come back to banks, as it certainly materializes, but it's obviously a source of concern always.
So how do you address that? Because one argument would be that it's precisely because the regulatory regime is too rigid in Europe that a lot of those flows have moved off balance sheet. Others would say you need to expand your scope. How do you address that risk?
Well, I think the key component, you're absolutely right, that of those two arguments, the key point is, well, how do we preserve financial stability? You know, some of the regulations that were put on the banks for them not to do certain of the actions that are being done outside the financial system, or they're just not being done at all, it was because there were threats to financial stability. So I think the key, from our perspective, the key is that that part that's outside the banking sector is properly assessed, risks are well evaluated, and if needed, regulated.
But, so what can you tell us about capital requirements? Are they adequate? Or is there too much burden because we're losing actually risks elsewhere? So how do you readjust that?
No, I think the capital requirements, you know, we've come through a decade since the world financial crisis already of 2008, 2010, in which we have enhanced and increased regulatory requirements across the board, not just in terms of capital, liquidity, governance, risk management. And I think that has proved to be useful as we've gone through 3 years of very difficult economic backgrounds and economic turbulence with COVID and now with the current year with all the geopolitical tensions. As we go forward, I think it's important to finish that job of post-financial, global financial crisis, which we still have pending parts of it, and make sure that we provide a more stable framework.
Well, that takes us to Basel III, and parts of Basel III being pushed back to 2025 was the decision earlier this year. Is there a risk there that compliance to some of these regulations, that Europe will end up out of sync with other regulatory jurisdictions? Are you concerned that some of these rules are being pushed back to 2025?
Well, I mean, I'm not pleased that they're being pushed back, to be honest, because, as I said, this is a result of the 2008-2010 crisis. So 15 years later, you cannot tell that we're going very fast in imposing these reforms. You know, it's certainly being stepwise. Where there's a risk of international coordination, I'm confident that that will not be the case. I mean, they still have to, from 2025 to 2030, there's still a transition period for another 5 years. And we just saw the UK proposal on the implementation of Basel III earlier this month, and they follow the similar calendar to the European Union. So there seems to be synchrony.
Yeah. Mr. Kampa, we're expecting actually on Friday, I think, a big overhaul, what the UK was talking about, the, Big Bang 2.0 to unleash the financial sector in the City of London. Are you expecting a lot of divergence from the European Union, and actually what does that mean for the EU?
Well, I don't know, but our hope and our commitment so far has been, from the European Union's point of view, they want to stick to global financial standards to preserve open markets. My understanding that's also the goal of the United Kingdom, and that would be good because that would mean that there's big coordination, So I hope that they will stick to the global.
When you hear officials here in London, in the UK, talking about a new Big Bang, do you roll your eyes? Do you take them seriously? Is it going to be more of a whimper than a Big Bang?
Well, I mean, we always take them seriously, of course, because the financial center in London and the UK is a very large, important part of the world financial center. But I think that I also, when I talk to them, I also hear them, as I said before, with their willingness to stick to global financial standards, to open markets, to open global financial markets. I think that's good. That's a good sign.
Where do you see the biggest fault line for banks? Is it loans? Is it housing? Is it mortgages? And are they taking adequate steps to look at the risks, or are they too blasé about them?
Yeah, I mean, as we look at their portfolios, it depends, of course, a little bit on each bank's business model. But in general, it's areas where leverage traditionally has been built up. So commercial real estate, residential mortgages in some countries of the Union, where mortgage prices and housing prices have been increasing a lot over the last few years. Leverage lending in the corporate sector, those are usually the areas of focus.
Okay, we talked a lot about the risks, but there is still this huge gap in terms of competitiveness between European banks and their US counterparts. So how do you build a framework that encourages growth for the banking sector that needs to drive the growth that we need to see across the economy. I'm just thinking of the European or the German finance minister saying that banking regulation is focused too much on stability and consumer protection and not enough on competitiveness and profits. Does he have a point?
Well, our mandate is financial stability, and I think that we need to preserve financial stability as an essence for a competitive environment. Of course, for financial stability, a precondition is to have businesses that do an adequate return on capital, because if not, they will not be able to sustain over the long term. So our focus right now is making sure that those business models are sustainable. I think that the interest rate environment will help them preserve those models as being more sustainable as we get what we will call normalization of interest rates going forward. That should be helpful for them. And they also need to address the challenges of technology and digitalization. That has big challenges on competition. And of course, for European Union, it's very important sustainability as well as we go forward.
All right, Mr. Campa, thank you so much. José Manuel Campa, there, chairperson of the EBA.
Yeah, really, really fascinating and important conversation. Thank you very much indeed. Coming up, we discuss Europe's economic outlook with Alfred Kammer, the director of the European Department at the IMF. We'll get their latest forecasts on growth for the Eurozone and inflation. Don't miss that exclusive interview next. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open. 41 minutes into your European trading day. You're seeing losses of 0.2% across European equities, a second day of losses. Futures in the US, though, turning around slightly, just up 0.1% on the S&P E-minis. On Europe, interesting to hear from the ECB's chief economist, Mr. Lane, saying that he does expect we're close to peak inflation, but more rate rises are likely. Francine.
Now, the euro area is set to start the year in recession with output flat for 2023 overall as high energy prices and tighter financial conditions drag. Joining us now is Alfred Kammer. He is the director of the European Department at the IMF. Great to join you. Thank you so much to join us. Thank you so much for being with us. So you also are part of our regulatory forum a little bit later on. Inflation, has it peaked in Europe? Will will it peak? Or what's the trend looking like over the next 2 quarters?
Yeah, inflation has been higher and more persistent than we expected. I think there's an expectation that the inflation will peak in the next couple of months. We are projecting that inflation will come down in 2023, headline inflation in particular. Core inflation will be a bit slower and will be more persistent, but that is a reflection of the pass-through of the gas price increase and in line with our projections in October.
Are you seeing any evidence, any indications that we're starting to get a sense of a wage price spiral? Wages have not risen as quickly in Europe as they have in the US, but is that starting to change?
This is correct. Wages have not risen as much as in Europe. At this stage, we don't see an expectation of a wage price spiral. A bit different in the emerging European markets, where wage pressures are stronger, where the credibility of monetary policy framework is not as much established as in advanced Europe's, and their central banks need to work harder in order to avoid the anchoring of inflation expectations.
Alfred, when you look at, I guess, the main concern going out there is that there's some kind of policy mistake or that we underestimate social unrest in Europe because of the cost of living rising. Where do you see the biggest fault point? So when you look at countries in Europe, is there one that looks much more vulnerable than others because of social policies?
I think it's an issue for whole of Europe. I think three things to say on this one. First, energy security is paramount, and the Europeans have stepped up in terms of increasing supply, getting gas storage levels up in order to survive this winter. And more is required, clearly, to ensure that enough gas is here for the next winter. Cost of living crisis is a big issue. Governments have taken measures in order to deal with the lower purchasing power which the populations have. We have been advocating more targeted measures, temporary measures, and measures which are not allowing the price signal to go through. Why is that important? Price signal needs to go through in order to lower demand. That is part of the energy security response. Target is important in order to lower the fiscal costs and the impact on inflationary pressures. And clearly temporary so that we are not going into a new subsidy regime for a long period of time. But these measures are extremely important. Yeah. We have been advocating more targeted because right now fiscal costs for 2022 are 1.8% of GDP on average across Europe. Half of those go into untargeted price type measures. Half the cost would protect 40% of the households.
So how do all of those factors play into your views and your forecasts around the trajectory of the economy into 2023? Give us a sense of where the forecasts are and how difficult it is to forecast within this environment.
Yeah, there's a lot of uncertainty, but we still expect that growth is going to slow down in 2023. We are expecting technical recession for most of the euro area countries. We are expecting that the euro area will go into a technical recession in the fourth quarter. We see these forecasts, which we made in October, right now borne out by developments. Q3 developments on growth were stronger than we expected. At the same time, gas prices have halved since August. This is helping on the positive side. Of course, inflation has been more persistent. That is a negative, and the purchasing power of the population has shrunk. Those are negatives on the forecast. But we expect shallow recessions with growth resuming in spring and not deep recessions at this stage. But the risks are to the downside.
Is it prudent for the ECB to hike into this environment?
On the monetary policy side and on the fiscal policy side, the stance needs to continue to be contractionary. On monetary policy, we are advising central banks to continue raising rates. Likely the European Central Bank will need to go into contractionary territory in 2023. Inflation has been more persistent than expected. It's higher than we expected. So more action by central banks is required. I should also say the inflation process has changed since Russia's war on Ukraine, with input costs playing a much larger role, supply chain disruptions playing a large role. And therefore, what is important, you mentioned the uncertainty. Central banks will need to make decisions month by month based on the incoming data. But what we are seeing right now, policy rate need to continue to increase and likely need to go into contractionary territory.
Okay, Alfred Karma, really important insights. Thank you very much indeed. Director of the European Department at the IMF on this more persistent inflation that we are seeing, but maybe a shallower recession in 2023 than some had expected. Really important insights. Thank you. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Bloomberg has learned the US and EU are weighing new tariffs on Chinese steel and aluminium as part of a bid to fight carbon emissions. The move would mark a novel approach as the US and EU would seek to use tariffs usually employed in trade disputes to further their climate agenda. The idea, which originated within President Biden's administration, is still in the initial phase and hasn't been formally proposed. Beijing is scrapping COVID test requirements to enter supermarkets and most public venues from today. The move marks a retreat from strict policies that at one point saw a testing booth on every corner in major cities. Negative 48-hour test results will still be required to enter bars, restaurants and schools. South Africa's governing ANC says it will tell its lawmakers to reject an independent panel's report that President Cyril Ramaphosa may be guilty of violating the constitution. Lawyers for the president are preparing a court challenge against the report that said there may be grounds for his impeachment over the handling of allegedly stolen money. A spokesman says Ramaphosa will not quit and will seek a second term as party leader. President Biden is likely to announce that he's running for re-election after the Christmas holidays. That's according to White House Chief of Staff Ron Klain. The president turned 80 last month and is already the oldest person ever to occupy the Oval Office. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thanks so much. Alice Atkins in London. Now, coming up, Tesla shares fall on a plan to cut output of EVs at its Shanghai factory. We have all of the details next, and this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. 52 minutes into the European trading day. You can see we're actually easing off today's lows. European stocks pretty much unchanged. The DAX and the CAC 40, same. The slight tilt to the upside. Now, we did have a resilient U.S. economy. We had that in services data yesterday. Also, sticky inflation, I guess, countering at the margin some of the optimism that we saw about a reopening in China. Money market futures, the one thing that we need to watch out today, and economists suggesting that the Fed will need to push rates to a higher peak than previously expected. Tom.
Okay, let's take a look at what else is on the agenda today. At 1:30 p.m. UK time, we're going to have US trade figures. Later, ECB Vice President Luis de Guindos participates in an ECOFIN meeting. That's in Brussels. And today, the first ever EU Western Balkans Summit. That's currently underway in Tirana in Albania, with Russia's war, of course, in Ukraine a major topic. Also today, Democrat Raphael Warnock and Republican Herschel Walker, well, they face off in Georgia's US Senate runoff.
Now, Tesla's shares have taken another leg low on reports that the EV maker is planning to lower production at its Shanghai factory. It's the latest sign that demand in China is just not meeting expectations. Well, joining us now is Craig Trudell, Bloomberg's Global Auto Czar. I still love saying that title, Craig, best title in the newsroom. Can you read from what Tesla's doing about a wider picture of the Chinese economy and what it means for EVs?
Yeah, there's a few things going on here. I think you heard Elon Musk on the last earnings call talk about the sort of real estate and property, challenges that the Chinese economy is having, and sort of picking up on a little bit of change in demand as a result of that. We've seen the waiting list for Teslas shrink quite a bit from earlier this year, where you previously were waiting quite a long time to take delivery. Now, basically you can order one and take delivery. You're seeing a lot of competition, so companies like BYD in particular is really growing, like gangbusters, and actually raising pricing, whereas Tesla has had to cut, which is has been a sign that maybe demand has softened a little bit. And you also have an issue of government policy and an incentive that is due to expire at the end of the year. And so what we may be seeing here is a sort of preparation on Tesla's part for a kind of hangover from the lifting of that support, lifting in the first quarter, and sort of preparing for the idea that the already sort of soft demand that they're feeling, they may feel more of that, even more so in the first quarter.
And Craig, as a Tesla investor, I'd imagine you'd be interested to know and get a sense of just how prolonged this is likely to be for Tesla. Is it short term? Is it a question of when the Chinese economy reopens, the economy is reinvigorated, that those sales are going to step up again, or is this more structural in terms of changing consumer trends, particularly around some of the competition in China?
Yeah, I think one big concern if you're an investor is pricing, right, and how much pricing power the company has, and obviously they have very strong margins, which is something that investors have been very happy about. But do we start to see a sort of pullback on their ability to price? And we've seen this story lasting for a couple of years now, where the problem for the industry has been production and not demand. And do we get to a point where we're no longer sort of constrained by production, and therefore pricing has to come down a little bit and pressures margins? And I think that's one of the things that is a big concern if you're an investor. The other thing that I would just flag too is that this is a plant obviously that's become a big export source of exports for Tesla. And so as they've ramped up the plant in Germany, is the factory in Shanghai no longer sort of as needed to feed the European market, and is that partially what's going on here too?
Okay, Craig Trudell, fantastic, as ever, on what is happening, the plight of Tesla. I'm not sure if plight may be a slightly strong word, but Tesla certainly taking a bit of a hit in its operations over in China. Bloomberg's Global Auto Czar, thank you very much indeed. That is it for the European Market Open. Surveillance Early Edition, of course, is up next. Brandstein stays helming the show for the next hour. The markets currently range-bound here in Europe. Futures in the US, though, pointing higher after 3 days of losses by about 0.2%, as investors weigh up, of course, the chances of a higher than expected terminal rate. Stay with us. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Re-rating rate bets. Global stocks struggle for direction as surprisingly strong U.S. services data fuel concern that the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an 8th consecutive month and warns there's more to come. The Aussie dollar climbs. Plus, the U.S. and the EU are said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity. So first thing is first, let's check in on the markets. Even U.S. futures for the moment are struggling for direction. It's very clear that we saw a resilient U.S. economy. That's on the back of services data yesterday. Also sticking inflation, really countering some of the optimism that we saw about reopening in China. Money market futures economists also suggesting that the Fed will actually need to push rates to higher peak than previously suggested. So this is a picture across the board for European stocks. I don't know whether we have a map to see whether there's a huge difference between Germany, France, Italy, and elsewhere. You can see it's pretty much flat. Just a little bit of gains for the DAX, but again, they're tiny gains, I think, as the market is trying to figure out what happens next, and so struggling for direction. So unexpectedly strong U.S. services data, adding fuel to traders' bets on how high the Fed rates hike will go. Now let's get straight to Alex Brazier. He is deputy head of the BlackRock Investment Institute. Also, for as many years, the Bank of England understands not only financial stability, but also what it takes to deal with inflation. Alex, thank you so much for joining us. We're at this pivot point. I don't know how you would describe it, whether it's crossroads, but the market is still grappling with the fact that even if we see peak inflation, then interest rates have to go up. Like, what's your terminal rate for Fed, but also here in Europe, ECB?
Yeah, I think, take a step back. I mean, we need to rethink what central banks are about now.
Yes.
For the past 30 years, they've been the cavalry that's come to the rescue when growth has slowed. But right now, they're actually needing to create economic damage to get inflation all the way down again. And that's why you won't see rates stop rising just because we see weak growth, and you'll see rates stay higher for longer as central banks really try and drive economies into very weak growth and inflation in order to make sure inflation comes all the way down or close to all the way down to their targets.
So how much pain will that inflict, I guess, on markets? The bond markets are seeing one thing, equities believe in something else.
Yeah, and I think, bond markets believe in rates reaching a terminal point and then coming back down again. Actually, that's a bit of the old playbook as well. In all likelihood, rates are going to go to 5, possibly north of 5 in the US. They're going to go to 2 3/4, possibly 3 in the Eurozone. But importantly, they will then stay there. as growth weakens, as those economies enter recession, because that's deliberately what the central banks are trying to create. They're trying to damage economies because they're effectively overheating. Even though the level of activity isn't back to its pre-COVID trend, we're seeing core inflation pressures because of all these supply-side constraints in labor supply, in energy supply, all of which mean economies can't operate at the level they were used to.
But so, Alex, are we underestimating then the timeline of how long it takes to unwind this great experiment?
No, I don't think so. I think the thing markets are underestimating is how far rates need to go and how long they need to stay there in order for central banks to deliver their objective.
And so, it's a terminal rate for the Fed is around what?
5, possibly a bit higher. For the ECB, 2 3/4, possibly a little higher. I think the difference is explained by a different level of neutral rates in those economies, but they're both effectively trying to do the same thing, which is take rates to restrictive territory and keep them there in order to generate effectively a recession, if not very, very weak growth for a sustained period.
I mean, one of the most heated debates I've had on neutral rates with Eric Nielsen, so massive shout out to Eric, to always trying to take the counter argument on anything that has to do with neutral rates. Alex, when you look at where we need to be, how much pain are we going to see in markets? And are we going to be in the stop-start equity market until we get to grips with the reality that you're explaining?
Yeah, in all likelihood, yes. And that's why we published our outlook last week. It's why we're not yet ready to be positive on developed market equities. But there will come a time next year, in all likelihood, where the degree of damage central banks are looking to create, we get clarity about that, and it's reflected in the price. At that point, we see big opportunities in developed market equities. So we're laying out not just a sort of fixed asset allocation for the year, but actually a sort of playbook for the year that says, if this, then this.
Yeah, and I know it's proprietary, so we won't publish it, but actually it's a beautiful outlook because it's very easily laid out and easy to read. When you look at what this means for a global or U.S. recession first, I mean, the Fed probably wants some kind of recession. So is it a misnomer talking about whether we can avoid one?
I think so. I mean, Powell talks about engineering a period of basically no growth for a sustained period. Now, it's very difficult to engineer that without some fall in output. But when you look at the numbers, we think given the labor supply constraints, particularly in the US, the Fed would need to engineer a fall in output of around about 2% over the course of the next year if it's going to get inflation down as quickly as possible. Now, in all likelihood, it's not going to go quite that far, but this goes to the point that it is deliberately creating economic damage and has acknowledged that now in order to try and get inflation as far down as it can on a reasonable time frame.
Alex, I know we'll talk a lot more about China shortly, but actually, how should we view China? I mean, this could be a huge game changer. If they really open up in March, April, what does it mean for energy prices? What does it mean for world productivity?
Yeah, I think there are two things going on in China. One, of course, is the reopening, which will be bumpy because even though the policy is lifted, the public health situation means that there will still be lockdowns. We'll probably see very weak growth in Q4, for example, as a result of this. But don't forget, China needs a big boost to domestic demand to combat what's happening to export demand. It was a huge beneficiary in the pandemic from the fact that we were all buying goods and not going out and consuming services. That's now turning around. And what was a 2-point boost to annual GDP growth in China is going to shift to being a 1 to 2 point drag on GDP. That's such a big turnaround that China really needs domestic demand to restart very rapidly if it's going to avoid a very severe slowing in overall aggregate demand.
Yeah, so I'll ask you what this means for regulation in a second. But when you look at financial stability, and this goes to their leverage. So if you go from 1%, 2% interest rates to 5% in a short period of time, where do you see the main fault lines? I know we're talking about, probably currency derivatives. There's pockets of the markets outside banks. How much of a concern are they to you?
Not a great concern, but there's always some risk that sharp moves in asset prices, particularly yields, as you highlight, expose something. We had the episode months ago in the UK, for example. Now, it's likely that when rates move this sharply, you'll see pockets like that. But I think this is a very different situation to the one in, say, 2008, where sharp moves in asset prices created a systemic problem. We will see pockets, but not a systemic issue.
So, do you worry about shadow banking? Should that be more at the forefront, zombie companies, shadow banking, a kind of...
No, I don't think so. And I think shadow banking is a bit of a misnomer as well. There are certainly things like shadow banks that are doing things that are banking-like. But sometimes people have a tendency to lump together the entire non-bank system. There are pockets of shadow banking, but I think they are reasonably small.
All right, thank you so much. Alex Brazier, their deputy head at BlackRock Investment Institute, stays with us. We'll talk a lot more, of course, about maybe some of the fault lines and whether there's even a tool for central banks to deal with some of these issues. Coming up, Chinese stocks climb as Beijing eases COVID testing rules. We discuss that next with Alex, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Australia's central bank raised its key interest rate to 3.1%, the highest level since November 2012. Well, Bloomberg's Kriti Gupta has the very latest. Kriti, I mean, it's huge, actually, in terms of what we could infer from it for other central banks, but also differences.
Absolutely. I mean, this is such an important decision because the context is everything. We were going into the decision saying that might not even be a hike at all. We might actually see the RBA actually pause. The markets were even pricing in 19 basis points. Economists saying 25 basis points is the hike that we were going to get, and the economists actually won out. Nevertheless, the effect you're seeing in the markets right now, a stronger Aussie dollar, yields on the front end really soaring. And I think what's crucial about this particular takeaway is that the RBA has traditionally been this early mover when it comes to central bank policy and monetary policy. They were the first to tighten and tighten aggressively because of the commodity exposure. They may also be the first to completely pause altogether. Back in October, they were the first to make that pivot to a 25 basis point hike. The step down we're talking about for the FOMC, for even the Bank of Canada that I believe we're going to get later today during the U.S. session, that is all, of course, being forecasted, or I should say, led ahead by the RBA's decision months ago.
So, Kriti, very briefly, I mean, the parallels to other countries are there, but it's also different, as you say, very commodity rich, very exposed to China.
Very exposed to China, and this is where you're starting to see the divergence. This is crucial as we talk about the RBA dealing with a housing market that is already kind of collapsing at a time when other global housing markets, think Canada, think the United States, even think right here in the UK, haven't seen that same deceleration. On top of that, the commodity exposure to the EM complex makes it extra sensitive to those moves, something that you haven't yet seen in the Fed, by the way.
Okay, fabulous. Of course, a great insight into some of the housing worries also globally. The RBA, they're looking at whether this is a kind of precedent or not for other central banks. Kriti Gupta there with the very latest. Now let's get back to Alex Brazier of BlackRock. Alex, so look, we put the spotlight on the RBA and trying to figure out whether actually this also reads into what China does or does next. And you beautifully explained that actually what China needs in terms of the strength of the economy is domestic consumption. On the back of that, do you expect regulation, some of the consumption on luxury and things like that to be lifted, or will they still be the moral police whilst at the same time growing elsewhere?
Yeah, I think two things. One is they're clear that they no longer have just a single kind of sole-minded pursuit of growth. Yeah. They have other objectives, Chinese authorities now. So policy response is more grudging than perhaps it was in the past, and that's one reason why we shouldn't expect the growth rates of old to be repeated in the future. The authorities will be more cautious. But I go back to this point that they will face big pressure now. And in fact, one of the reasons behind this COVID reopening, in addition to the social pressures, is the economic pressure that export growth is really coming off as a result of what's happening in the rest of the world. And as a result, China needs domestic spending to get going again in order to kind of fill the hole.
How do they do that? And again, and even if you look at the COVID policy, are you expecting it to be fully reopened by March, April, or are we going to see that stop and start like we have over the last 7 months?
Well, I think the policy in name will be loosened gradually over coming months, possibly quite quickly. But then the focus switches to, well, what actually matters in reality, which is the public health issue. And with relatively low elderly vaccination rates, limited ICU capacity compared to the West, that will place limits on how far the local authorities can actually reopen. And so we'll see a pretty bumpy path out of this, even though the policy in name is lifted.
Alex, we talk day in, day out, of course, about the UK, and I feel like the situation economically is just quite depressing. Surveys say, look, it's going to get worse from here. It's cost of living crisis. We're going into like a month of discontent with strikes. Do you see any, I don't know if it's reason for hope or a kind of glimmer on the UK assets?
I think they have repriced materially in some places, but the UK is a classic case in point of this issue that the central bank, if it wants to get inflation all the way down to its target, actually needs to generate a recession. And that's because the UK has the labour supply issues of the US, and by the way, Australia, and the energy supply issues of Europe, both thrown in together. So everybody else has one of those, the UK has both. And that means the trade-off faced by the Bank of England is perhaps even more acute than the trade-off faced by other central banks. It acknowledged that somewhat earlier than the others, but what it means is that rates are going up even as the economy enters a recession. And this goes to this point that we need to really think differently about central banks in this kind of supply-constrained environment.
So what lens do you look at it through? Are we definitely going to see a housing crisis? We saw, for example, mortgage rates coming off a touch. I mean, from 6 to 5.9, but is that a trend?
Yeah, I think the bank is trying to signal, and I subscribe to this view actually, that rates probably won't go as high as the market was pricing. And that's not because there won't be a recession, or the bank's trying to avoid a recession. That's because the energy shock and the rise in rates that's already baked in, and the effect that will have on the mortgage market, will already act to dampen demand very significantly. So if you like, the additional work the bank needs to do on top of that is somewhat less. But I don't think, and the bank will try and avoid a mortgage crisis, as you put it, but nothing escapes the fact that the UK needs a recession if the bank wants to get inflation all the way back down to 2.
What kind of recession do you think we'll get in the UK?
Well, there are two possibilities. One is that we get a reasonably sized recession over the next 3 to 4 quarters. The other is that the bank manages to engineer a period, and this is consistent with its forecasts, I think, of reasonably weak growth, or 0 to slightly negative growth for a sustained period. You look at its forecast, it's talking about no growth in aggregate over a 2 to 3 year period. That's very serious. Even if there are no outright output falls in that, and there probably will be, that's a very weak sustained period.
What has Brexit done to some of the economic prospects, and actually what can the government do to try and make up for that?
Well, perhaps start with what it can't do, which is, as we saw earlier in the summer, spend its way out of this, because increased fiscal stimulus doesn't change the underlying economics here. It doesn't change the fact that the bank needs a recession to get inflation down. It just means it needs to raise rates more to deliver the same recession. So what's really needed, not just in the UK, but in other economies too, is, and it's easy to say this, less easy to deliver, is supply-side reform. Things that boost labor supply, things that boost energy supply, things that boost productivity. But those things all take a long time to work through, a long time.
But so that's what, economically, if you just look at a spreadsheet, this is what, more immigration,
Potentially, although it depends. Governments have different trade-offs in that space. Australia is a good case in point, where the working age population growth has slowed hugely, just like it has in the US as well, as a result of an aging population there. And that's something governments need to grapple with, is how to maintain labour supply in an environment where populations are aging and natural participation rates in the labour force are falling.
Do you have any worries, and you were for 10 years at Bank of England in charge of financial stability, do you have any concerns, given all of these pressure points, that something could turn in the UK? Well, in terms of financial stability?
I think actually we had a good test run earlier in the year, and there were some difficulties. They've been smoothed through now. But I think as a result of that, I feel slightly more confident about the UK's ability to withstand some of this economic damage that's coming than perhaps I would have done 6 to 9 months ago.
I mean, could the UK actually be a crypto capital, or do we even want to be a crypto capital anymore, given what happened to FTX?
Well, I think on crypto, it's very important to distinguish the different aspects of this system. It's not some homogeneous lump. Things like properly stable, properly regulated stable coins, reasonable prospect. Things like tokenization of financial assets, really interesting prospect. But there's a lot of stuff around that that's very, very different. And so proper regulation to, if you like, separate some of these things that have real prospects from some of the other stuff, I think is very important in whatever jurisdiction, in making sure this can develop sustainably.
Alex, thank you so much. Alex Brazier, always on point, deputy head there at the BlackRock Investment Institute, joining us this morning. Now, coming up a little bit later in the program, as Ukraine fights for survival on the battlefield, we also focus on the beginning to turn Kyiv's finances and the cost of rebuilding the war-torn country. We actually speak to an official from the Ukrainian government. This is a Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Bloomberg has learned the US and EU are weighing new tariffs on Chinese steel and aluminium as part of a bid to fight carbon emissions. The move would mark a novel approach as the US and EU would seek to use tariffs usually employed in trade disputes to further their climate agenda. The idea, which originated within President Joe Biden's administration, is still in the initial phase and hasn't been formally proposed. Now, South Africa's governing ANC says it will tell its lawmakers to reject an independent panel's report that President Cyril Ramaphosa may be guilty of violating the Constitution. Lawyers for the president are preparing a court challenge against the report that said there may be grounds for his impeachment over the handling of allegedly stolen money. A spokesman says Ramaphosa will not quit and will seek a second term as the party leader. Now, the UK is said to be planning to announce measures this Friday aimed at boosting growth right here in the City of London. Sources tell Bloomberg the Treasury will sweep away unnecessary regulations on financial services in a bid to rescue new post-Brexit opportunities and boost competitiveness. Two policies floated so far are the repeal of the banker bonus cap and adjustments to the ring fencing regime. And former President Donald Trump plans to hold a telephone rally for the Republican candidate ahead of Georgia's Senate runoff election today, opting not to campaign in person. Polls indicate the result will be close between the two parties. The election will determine whether Democrats win a 51st seat in the Senate, making it easier to pass legislation. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, markets really struggling for direction today. Traders actually weighing on a prospects for a slowdown in the pace of U.S. rate hikes. So let's have a look at the markets. If we have them, to look at the boards. And, of course, we want to put that against data that's showing, for example, that there's tighter policy that may be needed for longer. Now, if you look at what we heard in the U.S., resilient U.S. economy, but also sticky inflation, really countering some of the optimism about a reopening in China. Money market futures, but also economists suggesting that the Fed will need to push rates to a higher peak than previously expected. Some of the other things we're watching, of course, apart from risk assets, is Beijing announcing it will scrap COVID testing requirements for most public venues. This really is seen as an accelerated move towards the exit of COVID zero policy. Coming up, a bleak winter. CBI warns that the UK has already fallen into a short and shallow recession that will leave business investment below pre-pandemic levels. We'll look at that next, and this is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm
very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Watch Bloomberg Surveillance Early Edition for the news you need when you need it.
I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Inflation hasn't been this high in the UK since 1981.
Then surveillance for in-depth analysis.
Jonathan Farrell, Lisa Bramwitz, and Tom Keene, thrilled you're with us.
Inflation in the United Kingdom, brutal.
Underlying food inflation doesn't appear to be that bad.
It ties back to the tenuous situation of what we're looking at with respect to energy.
Bloomberg Surveillance. Be informed. Be prepared. Be ahead of the game. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Re-rating rate bets. Well, global stocks struggle for direction as surprisingly strong U.S. services data feel concerned that the Fed will need to tighten more than expected. Not done yet. The Reserve Bank of Australia raises its benchmark for an 8th consecutive month and warns there's more to come. The Aussie dollar climbs. Plus, the U.S. and EU are said to be weighing joint tariffs on Chinese steel and aluminium to fight emissions and global overcapacity. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. So the CPI is warning that the UK economy faces a decade of lost growth unless the government takes action on investment tax relief, see Northern Ireland Protocol, and the shrinking workforce. Now, the Business Lobby Group says the UK has already fallen into a recession that will leave business investments 9% below pre-pandemic levels. Now, we're joined exclusively by Rob Hornby. He's head of EMEA at Alex Partners. Alex Partners, of course, being a big turnaround company. Rob, thanks so much for joining us. I mean, there's so much going on in the UK. I feel like every day there's like a downbeat headline on the recession because of all the problems that other countries have, but really kind of put into one here. What does it mean in terms of the stress levels that companies in the UK will face?
I actually can't remember a time like this where long-term trends and short-term trends have kind of got companies in their jaws. And the job of chief executives in particular, but executives and boards, I think is pretty tough because they're having to fight tactically day by day and also not forget that there's long-term trends that could do them significant damage in the long term if they don't continue to invest.
So that means it's ugly. Is it an ugly picture? Like, how many companies could actually go under?
Of course, that's the million-dollar question, isn't it? But it's a strange situation, and I think it's unlike some previous recessions because all the cheap money that was out there was either covenant light or in some cases covenant free. So we're not going to see the classic triggers taking companies into restructuring. Of course, there might be some auditors who become worried about signing the going concern, especially with year ends and calendar year ends coinciding.
So you're expecting bankruptcies, Rob? When you
we will see that.
UK
yes.
PLC, are there sectors that seem more vulnerable because they're over leveraged because they borrowed more and now can't cope with the pending recession?
That's definitely the case, but I think it's deeper than that because even healthy companies are facing extraordinary pressures. Anyone who's moving a widget, anyone who's got a customer who is a person struggling with the cost of living crisis, I think is under a degree of threat.
And this is after 2 years of pandemic. So is there anything that a lot of these companies can do now, or is it almost too late because we're now into the winter, energy prices are going up, supply chains are still a struggle, and everything's just getting so much more expensive?
It's never too late to take action. I think perhaps the most frightening thing would be just sitting there and hoping it will end, because the long-term trends are not going to end, and the short-term ones look a bit medium-term increasingly. So taking action, I think, is imperative. Companies need to fight every day, fight for supply chain, fight to retain their customers.
but they also need to keep investing and keep thinking about the future.
Yeah, and that's pretty basic. As a chief executive, that's kind of what you want to do. But there's no quick fix. Is there any government help that they can have? Like, if you dig a little deeper, is there a sector that you're particularly worried about just because of the leverage finance? And again, it's not the same if you have interest rates at 1%, if they go to 4 or 5% in a short amount of time.
I think we have to be worried about all consumer-facing industries at the moment, because if we do have a recession, of course we're technically in one now, that's likely to put enormous pressure on customer-facing businesses that have been under pressure in the pandemic. And then anyone who has a physical product is struggling, particularly if they have globalized supply chains.
So, Rob, are we talking about 15% of companies potentially going under? I know at the beginning of the summer, I think we saw some surveys saying, look, 1 in 5 are in danger. Like, what kind of figures are you looking at? Like, have you hired extra staff to deal with potential bankruptcies in the UK?
So we are expecting a very busy time. I think it will be a brave person who put a number on it, but we are expecting it to become progressively busy. I don't think it'll become dramatically busy.
I was going to ask, is there a crunch time? So once you get into the winter months, does it get easier? If you look at CBI, if you look at some other projections, crunch time could also be third quarter of 2023.
I think the end of the year is always a crunch because there are lots of fiscal year ends coming up, and I think that's a day of reckoning for some companies. But as we get into an extended period and the long-term stresses of the short-term pressures, I think we could see companies that have lasted and lasted and lasted finally just have nothing left.
What does nothing less mean? Like actual having to close down, or is there a period of moratorium? Like how does it work after the furlough schemes and the 2 years of pandemic?
I think the simplest issue is that they run out of cash eventually. Of course, there's been a lot of cheap money. There's been a lot of government help. And that's kept companies who really shouldn't be functioning at this stage in a normal way, appearing to do just that. And that is going to run out. The question is when. And I think over the course of next year.
So, Rob, you're telling me two things, right? It's companies that maybe shouldn't have not survived this long, that have survived, that could go bust, but ones that are also healthy, that are also at risk of going bust. Like, how do you differentiate the two? So if you're an investor, if you're a private equity, if you want to go in, like, how do you tell the difference?
Healthy companies are probably not at risk of going bust in 2023, but the long-term trends were very disruptive already. Digital, demographic shifts, they haven't gone away. So I think we're going to find the long-term effects of those making companies that seem healthy today uncompetitive, and I think all the short-term pressures are going to accelerate and compound the long-term trends. And companies today that look great, I think we could see them struggle in the second half of next year.
All right, Rob, thank you so much. Rob Hornby, their head of EMEA at Alex Partners, joining us this morning on the UK. Now, coming up, as Ukraine fights for survival on the battlefield, focus is beginning to turn on Kyiv's finances and the cost of rebuilding the war-torn country. We speak to the Ukrainian government's Commissioner for Public Debt Management, Yuri Butsa. That's coming up next, and this is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You got to think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on Ukraine's economy. Its central bank governor has told Forbes it will likely cut its economic outlook following Russia's continuing attacks on the country's energy system. Meanwhile, further sovereign debt restructuring from Ukraine is also expected following the deal with bondholders to defer debt payments reached in summer, with the latest figures showing that the economy contracted 31% in the year to October. Now, we're joined by Yuri Butsa, Ukraine Government Commissioner for Public Debt Management. Thank you so much, Mr. Butsa, for joining us on such an important topic. If we're going to rebuild Ukraine, it starts also with bond restructuring and, of course, some of the deferred, debt payments. Where do you see debt payments and the deference actually being resolved? What's the right way forward?
So it's an interesting question, because when we came with the proposal to the investors back in summer, so we had pretty much two things to keep in mind. The first one is that we need to preserve liquidity. Yeah. The second one, that is full uncertainty, and we don't know what will happen in 2 years from now. So that was the proposal from our side to postpone it for 2 years and see what happens. So at the moment of time, we still need liquidity and still have no visibility what will be 2024. So it's very hard to say that we have any precise idea at the moment of time, but we keep on being engaged with investors and keep on talking to them and see their view and see their expectations, because in any way, whatever we'll come up with, we view it as really as a previous transaction in coordination with investors and investor-friendly approach.
And this is this is extremely complicated, of course, because of the ongoing war in Ukraine. But under what conditions do you see a restructuring possible? And would the Ukrainian government insist on a haircut for investors?
It's very too early to say, because there are both positive and negative scenarios which can materialize. What we need to have as a prerequisite for any discussion is a sound macro framework for at least 3 years to see what will be the debt burden. So if you look at the total debt stock, it's not that big. In absolute terms, it's getting bigger comparing to GDP, because we're losing a big part of GDP due to the Russian attacks. So that's a big problem. And we need to have a bit of more certainty in terms of what will be GDP trajectory before making any decision.
So is that also true for, and we're trying to figure out, of course, as investors, to give the best opportunity for people that want to invest in Ukraine or that will invest in the future, is trying to understand the level of haircut that would be acceptable both for creditors but also for the government. Is there a range for that?
Look, we are not in that type of discussion. What we clearly understand is that we need to preserve the interest of investors, because there are no other investors to Ukraine. So the same investors we rely on money is the same as the current investors to our bonds. And that's why any solution we will discuss, it should be really accepted by the market in the first place.
There's a number of Ukrainian corporates buying back some of their debt. Is it an option for the government to do the same?
Look, from economic standpoint, is the most optimal solution, because the debt is traded at 20 cents to the dollar now, Ukrainian sovereign debt, and there are no restructurings. I remember in other countries being done which had bigger savings than that. But that's about economics, right? If you talk about the priorities, so obviously priorities of the government is to use our resources which we collect to fund the military expenditures, and use the donor resources to fund all the social and humanitarian expenditures. And that's so we are much more preoccupied now to find all these resources for the 2023 rather than think about payments and 2024. However, yes, we understand why corporates are doing that, because that's the way how to create a much more of long-term or mid-term savings in the current environment.
So when you look at the government financing, how much is domestic debt attractive compared to other international financing sources?
Look, domestic debt was a key source for funding for us when the war started, mostly because of the sympathy from domestic both financial institutions, but also the population. So we see now that there are a lot of support through the war bonds by Ukrainian population, and we make it as quick as interactive as possible to enter to that market for the private individuals. In terms of general government bond market, we see a bit of revival now. We see that we started this year when people were looking at very short-term instruments, mostly like just to continue support. Now there is genuine interest to something which is maturing second half of 2024. So we see the financial system starts to look how to lock themselves in the higher yields post the tightening cycle of the central bank, and that's really a good sign for us.
I mean, of course, we follow on Bloomberg, a lot of the trials and tribulations and, the incredible saddening images coming out of Ukraine. In the last 3 to 4 weeks, there's also been huge, enormous hits to infrastructure, energy from Russia. I think when you updated investors and the markets on your budget for 2023, that had not happened yet. So do you have to change the amount of money you need to rebuild some of those hit infrastructure projects?
Look, this calculation, unfortunately, increasing every week, and those numbers going up. So we're looking at combination of sources because most of the damages are done on the level of companies, and sometimes it's easier for us to ask the donors to provide the funding directly to the company, like Ukrenergo, for instance, who can get the funding from EBRD because EBRD is, or EIB, for instance, and they help them already, and get the grants directly to the company rather than channel them through the budget because it's more lengthy process and less efficient. But we help as a government in all possible ways for the companies to have this funding in place.
Do you have a number in mind? And it's terrible, really, putting numbers on also the loss of lives. But I know the IMF were saying put some $3 billion a month, I think, into next year.
In very immediate funding, we already committed, and the company's committed, is hundreds of millions of dollars already. So I wouldn't expect it to be below a couple of $1 billion in the total cost. So I would think that IMF numbers are really showing the approximate range. Unfortunately, as I said, those numbers are increasing the more Russia tries to hit the civil infrastructure in Ukraine.
If there's any of the money delayed, actually, from the EU into Ukraine into next year, is there anything that could substitute that source of funding?
Look, we hope that this next year will be a bit different in that sense in terms of predictability. We really count on today's positive decision of Council of Ministers in EU because if there are delays in disbursement, so the only alternative, because we cannot stop paying pensions and salaries, so the only alternative for us is monetary financing, and we don't want to rely on that source. So we hope that next year will be more predictable in terms of timing of disbursements.
All right, Yuri Butsa, thank you so much. Of course, we, first and foremost, think of the people of Ukraine and everyone who's losing their life, but also an important conversation on some of the public debt and financing. He is Government Commissioner for Public Debt Management in Ukraine. Thank you for joining us today. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Beijing is scrapping COVID test requirements to enter supermarkets and most public venues from today. The move marks a retreat from strict policies that at one point saw a testing booth on every corner in major cities. Negative 48-hour test results will still be required to enter bars, restaurants, and also schools. Taiwan's Honhai, also known as Foxconn, has reported sales for November down more than 11% from the previous year after shipments were affected by a COVID outbreak in central China. Last month's outbreak led to a worker exodus and violent protests at its factory in the city of Shenzhou. The plant is where the bulk of the world's iPhone Pro handsets are assembled. Now, Apple has been sued by 2 women who say its AirTag devices make it easy for stalkers to track their victims. The small tags, about 3 centimeters in diameter, are intended to be slipped into or attached to personal possessions, like your backpack or your keys, to help owners locate them. But privacy advocates have warned it can also be used to track people without consent. Apple, which advertised the AirTag as stalker-proof, didn't immediately respond to a request for comment. And PepsiCo is reported to be laying off hundreds of workers at various headquarters in North America. Dow Jones says the jobs will go into its beverage business based in New York, and at its snacks and packaged food units in Illinois and Texas. PepsiCo employs around 130,000 people in the US and 300,000 around the world. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne Gerrans. Now, we're also getting some figures from IATA, the global airline industry, they say, is expected to report a $4.7 billion profit in 2023. Now, the chief economist also sees no major risk of global recession. That, frankly, is a surprise given some of the figures that we had, but maybe they're looking at travel demand to and from places that will not be affected as much as recessionary pressures we could see elsewhere. The chief, of course, of IATA also saying actually the worst for the moment is over. This is the International Air Transport Association predicting that the airline industry will book a profit next year. It's first since the start of COVID as travel rebound in the US mainly, for example, makes up for the impact of continuing curbs in China. Now stay with us for more on that report. We'll be speaking with the IATA Chief Executive, Willie Walsh, at 4 p.m. London time. That's 11 a.m. in New York. Now coming up, Tesla shares fall on a plan to cut output of EVs at its Shanghai factory. We have the details next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Tesla shares took another leg lower yesterday on reports that the EV maker is planning to lower production at its Shanghai factory. It's the latest sign that demand in China is not meeting expectations. Now, joining us now is Craig Trudell, Bloomberg's global auto czar. Craig, also on Twitter Watch. I'm kidding. He does focus more on cars, but there's that little distraction of Elon Musk tweeting on Tesla. Like, what can you tell us about China? It's not. I mean, it's not doom and gloom, but also it's not looking great.
Yeah, it is. There's some real nuance to this story, right? Where we just yesterday got some really significant numbers in terms of deliveries for Tesla in China. This is not a company that's really hurting in that market, but it is a question of, can they continue to grow the way they've been growing year after year? And increasingly, there are some sort of warning signals that in order to achieve that growth, they may need to, bring price down. And that's, going to alarm some analysts who, got used to this company not only growing at really impressive rates year after year, but doing so with really strong margins. And, is this a matter of, a low margin business, the auto industry, eventually catching up with this company that, has managed to post much bigger margins and growth, year after year.
So, Greg, what does this mean for, is this really all China demand? Is it actually the factory on how they operate, and how can you turn it around?
I think it's also a case of, increasing capacity globally, right? So, we've had 2 factory openings this year, one in Germany and one in Texas. And so, this idea that, finding the sort of demand and production balance and getting to a point where, maybe production has caught up with demand, what does that do to the dynamics of Tesla and to those margins that everyone has gotten used to, being bigger, higher than other competitors? So.
Is it kind of like a warning shot for other EV makers, or is it specific to Tesla?
Well, interestingly, we've seen some price increases by some of Tesla's competitors, and I think that's another reason that there's a bit of cause for concern here. Principally BYD, I think, is the company that has most gotten attention for both the pace of their growth and the sort of competitive dynamics, the fact that they're moving some prices up. And also, moving up into the segments that Tesla competes in, higher price EVs. That's another reason to be a little bit concerned if you're, invested in Tesla.
So, Christmas time in London, a lot of dinner parties, and everyone's saying, like, what do you think of Elon Musk? And I'm like, I don't know. Let's ask Craig. The amount of tweeting he does. Is this damaging him, or is it just kind of like a side job? I think it's definitely damaging Tesla because he can say every now and then, and he has for every 20 tweets about Twitter, he sort of insists I still have my eye on the ball with Tesla, but it's sort of belied by the fact that those other 19 are all about Twitter, and I'm probably being generous there in terms of the volume of Twitter-related tweets that he's doing. So absolutely, it's a distraction, and it's sort of the realization of everyone's concern when he was interested in this company months ago that this was going to be more than just a fad or a passing phase on his part. You're not a car editor at all. You're like a Twitter now, right?
I'm a new social
Twitter
media.
Watch. There you go, surprise. We'll find your new title. Craig, thank you so much. As always, Craig Trudell there, Bloomberg's global auto czar with a side job of looking at Elon Musk on Twitter. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kay Lines in New York, and Edwards here in London. The focus firmly, of course, on some of the jobs on data that we had overall in the U.S. If we're seeing stronger growth, certainly for services, what does that mean for the Fed's terminal rate? That's coming up next, and this is Bloomberg.
Fundamentally, it's done through the equity markets.
A Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
The idea that there's going to be a major pause or pivot, I think, is pretty unrealistic.
It takes a lot to slow this freight train.
They will have to stay at this restrictive level for a period to come.
The Fed cannot really pause or cut. It has to continue, but is going on a track now of slower hikes and try to feel out where we get the right level of interest rates.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. European futures and Asian stocks have been heading lower. The latest economic data has investors betting that the Fed's terminal rate will be higher than expected. U.S. futures struggle a little for direction. A novel approach by the US and EU. They're considering new tariffs on Chinese steel and aluminum as part of their fight against carbon emissions. And voters in Georgia decide today what the United States Senate will look like for the next 2 years. They're going to the polls or in a runoff election. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And European equity markets then a little sluggish today. Kaylee, US futures actually now turning that indecision into some slight gains, but we didn't need reminding over the last 24 hours that good data, good news on the economy can be bad for risk assets.
Yeah, especially if it means the Federal Reserve is ultimately going to have to go harder for longer and we end up at a higher terminal rate for an extended period of time. That is something that equity markets really around the world are contending with and why we saw such a mixed session in Asia overnight. You did have equities in China, for example, positive on the day. You are still getting those incremental updates on the relaxation of COVID restrictions and testing rules. So that lifted equities there, but overall the MSCI Asia Pacific Index down about 1% as the Fed is really under consideration for a lot of Asian risk assets and Asian currencies as well, most of them weakening against the US dollar today, including the South Korean won, the big underperformer among Asian currencies, weaker against the dollar by more than 2%, heading for its worst day since March of 2020. Right now, dollar won trading at 13.19 at the moment. And the Aussie dollar, I would note though, is gaining against the US dollar by about 1/4%, trading right now at around 67 cents on the dollar after the RBA, as expected, hiked rates 25 basis points. What maybe was less expected is the fact that they said they are not done and that policy is not on a preset course. So perhaps a little bit more hawkish than anticipated, which is what is leading to that Aussie strength and leading yields higher in the Australian bond market. That 3-year yield up 7 basis points overnight to 3.086%, Matt.
All right, we're looking at a little bit of a turnaround for sentiment here, at least momentarily. We have S&P futures unchanged, and we had been gaining earlier this morning after the big drop that we saw in the cash trade yesterday. The S&P was down 1.8% yesterday. The NASDAQ off almost 2%. So it did look like we were going to have a rebound. Now, not so sure. You can see S&P futures unchanged at 4,005. The cash trade closed at 39.98. The dollar index, maybe one reason, gaining a little bit of steam, up about 0.1% at 1267. So not a lot of strength, but at least a green arrow there. We did see a turnaround as well in crude. At least I saw Brent up earlier in the session, and it is now unchanged. NYMEX crude is down about 1/3% at 76.67 a barrel. Finally, Bitcoin showing its, I guess, can I say trademark stability? Is that fair for the underlying asset? After the collapse of FTX, we dropped to 16,000. We've been holding there for over a month now. We have risen. Yesterday, we rose up over 17,000 briefly, and we're holding at around that level right now, Anna, $16,980. What do you see in terms of the European markets?
Yeah, well, we seem to be telling the story of the last 24 hours, Matt, which seems pretty clear. The story from here, less clear, as you just showed in US futures. They've been a little more positive than that earlier on, now fairly flat on the US futures picture. This is what European markets look like right now, but really playing catch up with Wall Street. So yesterday we saw that services data out of the United States weighing on sentiment because it was strong on the back of strong jobs data on Friday. And finally, the market plays catch up with its thinking around the terminal rate and what that means for Fed expectations. So that is all weighing on European stocks today. Not weighing on the utilities sector. I put that one in because it's one of the bright spots, up by 0.2% on utilities. Marston's is a pub business. So whilst the World Cup, the soccer, the football tournament that is currently taking place, of course, in Qatar, might not be good for trading volumes when it comes to equity markets, but it's certainly good for pub drinking volumes, and that seems to be the story coming out of Marston's, although the share price there was higher a moment ago. The natural gas price was up by 4% a little bit earlier on, now up by just 1%. This on the back of some of our reporting that suggests that the weather is going to get colder here in Europe over the next couple of weeks. Some of that long-range or medium-term forecast suggesting in the next couple of weeks we will get an Arctic blast, and only southern Europe will be spared from that, much of Europe going into freezing temperatures. South Africa, the 10-year yield in focus here. This is obviously to do with the political tension. We heard from Fitch, the ratings agency, Matt, just yesterday, saying that all of the drama surrounding Cyril Ramaphosa, his fight for political survival, that is adding to uncertainty around policy. And so we keep that in mind as we look at what's happening to debt globally, Matt.
All right, we'll keep all of that in mind as we look at investors right now loading up on bets that an economic recession could be avoided. At least that's according to a study from Goldman Sachs of assets totaling about $5 trillion. Bloomberg TV's Kriti Gupta joins us now with the details. So, Kriti, what's the argument for a soft landing here?
Well, the argument for a soft landing is pretty simple. If you are worried about the Federal Reserve essentially tanking the economy in order to fight inflation, well, the mantra is going to be sell everything. And that's kind of what you've seen with the carnage of 2022. But David Kostin over at Goldman Sachs is saying, well, actually, if you look underneath all of the bearish bets, you can actually see some outperformance from a lot of the cyclical names. Think industrials, think financials. A lot of the sectors that are supposed to outperform in a growth phase, in an expansionary phase, those are the ones actually outperforming even as they're pricing in a recession at the benchmark level. On a more sector basis or on an individual stock basis, you're not necessarily seeing that. Is that a function of people just being late to the game, of people closing out positions earlier before the year's actually ending, or is this an actual change in terms of the mindset of whether or not the confidence is actually in the Federal Reserve?
So, Kriti, it becomes a question of whether or not Kostin's take is the right one. How does that track with what we're hearing from other strategists and their expectations for next year?
Well, I think the way to look at it is just the most recent market move that you are actually seeing from the trough, I believe, going back to October 12th. Remember, we are dealing with an era for the stock market of essentially these bear market rallies, and whether or not one of them will turn into a more sustainable rally for the equity market. And so far, with every rally, you have actually seen exactly what David Kostin over at Goldman is actually talking about, the idea that it is led by those cyclical names. Once again, financials, capital goods, industrial equipment names, even semiconductors, which are now being kind of counted as more of a cyclical basis instead of defensive under the tech name. So by that standard, Kaylee, David Kostin's right.
Kriti, thanks very much. Bloomberg's Kriti Gupta in London for us this week, but with the lowdown on the markets there and the Fed narrative. Now, in China, a COVID outbreak that began last month appears to be tailing off. Infections have fallen each of the last 8 days, but at the same time, there's been a pullback in the sweeping testing regime in major cities. Could these things be linked? Bloomberg guests weighed in on their outlook on China reopening.
China only grew 3% this year as against an expectation of 5%. So now the authorities are pressing forward on all gears to get to the 5% GDP number next year.
If China is going to continue to soften the COVID rules over time, fully reopening of the China economy would be really risk on.
The way to reopening is likely to be a lengthy and relatively bumpy one. And with market probably already getting slightly ahead of itself.
We're cautiously optimistic on reopening in China. It's going to be one of the big stories next year. We think there's probably significant upside to go, let's say 25 to 40%.
Rebecca Jung-Wilkins, Bloomberg Asia Government and Politics correspondent, joins us now from Hong Kong with more. I mean, there is a sense that perhaps if you test less, you find fewer cases, Rebecca, but the reopening enthusiasm continues as we continue to watch, perhaps with some worry, rising COVID rates in recent days.
Absolutely, and it is worth saying that testing overall is still actually relatively high when you think about the sort of nationwide push and fervor with which they test. The general sense is that they have a very accurate sense of numbers because of this widespread testing. Of course, when we see a pullback, potentially that could influence the falling cases, although the pullback is relatively new. So we're seeing it first in sort of Beijing and other major cities, Shanghai, Hangzhou, and so on, where essentially you no longer need a negative test to enter quite a variety of public venues. I think that the feeling is that that is going to continue to be rolled out across China, and possibly the infection rates overall have now crested from that November peak that we saw, somewhere around 39,000 cases a day.
So what do you see in terms of emergency room occupation there? What do you see in terms of deaths?
Well, that's certainly the big concern, to what extent we see this quote-unquote disorderly exit from COVID. Now, I think that Becky Liu's comments from Stanchot are probably the most apposite here. It's going to be a lengthy and a bumpy road. The real concern is that in China, access to healthcare is, of course, incredibly divergent. So if we look at, for example, Beijing's capacity to cope, has the best healthcare system of any city in China. They obviously will have a much better ability to deal with rising cases. And in Beijing, for example, we are seeing low-risk patients being allowed to stay in quarantine at home. Now, that's going to be very, very different if you look at sort of, for example, some of the poorer areas and also some of the more rural areas of China where there won't be the same access to care. The other element of this is also persuading people who have been so frightened about catching COVID that it is sort of safe to, quote unquote, re-emerge in a way. And we are seeing, again, state media narratives sort of playing up this idea that local governments are taking really sort of extreme steps to keep people safe, as well as giving us guidance on how to actually avoid catching COVID.
All right, Bloomberg's Rebecca Chung-Wilkins, thank you so much. Meanwhile, Bloomberg has learned that the U.S. and EU are considering new tariffs on Chinese steel and aluminum. Talks between the U.S. and EU to jointly address the climate crisis are a positive sign after Biden's signature climate law has been criticized by European leaders for discriminating against the EU. So, Anna, this is definitely an interesting one, especially on the tails of the meeting between President of France, Emmanuel Macron, and President Biden at the White House last week, where some of the U.S.'s policies around EV credits, for example, here in the U.S., were a point of contention.
Yeah, absolutely. So there did seem to be this transatlantic tension around the Inflation Reduction Act and the way it was going to support U.S. business, and in the views of Europe, weigh on European business. And we're just seeing President Emmanuel Macron actually arriving at a conference that is taking place in Albania, in Tirana in Albania. He's arriving at that summit and giving his comments ahead of that. But back to the trade story then, Matt. Interesting to see that this policy around, trade policy is being used to try and influence climate policy in China.
Yeah, I think it's really fascinating because previously we slapped tariffs, we meaning the U.S. and the EU, on China for trade reasons, and now we're at least using the excuse of saving the world for doing the same job, Kaylee. So it'll be interesting to see how China responds to those tariffs. Maybe they'll slap some counter tariffs on us to save the world as well.
Could we be talking about another trade war of some sort? All right, let's get back to the equity markets and talk less about geopolitics. Take a look at some stocks moving in pre-market trading here in the U.S. One of the biggest ones being GitLab. It is actually surging about 18%. It's a software company. Not only did it beat on revenue estimates in the third quarter, its forecast also topped expectations. Analysts noting that the company is proving pretty resilient even as IT spending budgets are getting cut back. So that is lifting the stock nicely this morning. It is also a move higher for another stock. And this one's an interesting one because there's not necessarily any real news, but Lucid Group, the EV maker, actually fell to a record low yesterday, bringing its losses for the year to about 75%. This morning, though, up about 1.6%. So maybe it's just a lot of people buying the dip. And one more stock moving to the upside is GE. This is off the back of analyst action. An analyst over at Oppenheimer upgrading the stock with a $104 price target, talking specifically about the strength in its aviation business. GE right now trading below that price target by a significant degree, right around $85.90 a share, up about 1.5% before the bell, Anna.
Okay, coming up on the program then, Kaylee, we'll get to the macro stories with Holger Schmieding, Berenberg's chief economist, joins us. What are his expectations for European growth and for global growth as we head into 2023? And voters head to the polls for the Georgia Senate race. We are live in Atlanta. We'll get the perspective on the ground and the broader implications for policymaking stateside. This is Bloomberg.
Right now, trading below that price target price.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Today, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
Welcome back to Bloomberg Surveillance, the early edition. I'm Matt Miller here in New York with Kaylee Lyons, Anna Edwards with us out of London. Now, if you're tracking the S&P this year, you'll note that we're in a bear market, but we've seen 3 or 4 little rallies here that continue to be brought down by good data, which makes the Fed, or makes at least the markets price in, a higher terminal rate for the Fed. The terminal rate continues to hit higher peaks as priced by the market. Right now we're at 5.22. Joining us now is Ksenia Galuchko, Bloomberg Equities team leader, to talk about how good news is bad news. Ksenia, on Friday it was the jobs number. Yesterday it was services, the ISM services figure that was just better than expected, and that leads markets to price in a higher terminal rate for the Fed.
That's right, Matt. But we also have to keep in mind that the rally that we've seen in the S&P 500 has been quite tremendous. It's been 17% from the bottom until the peak. So that has been a very, very formidable rally. And it's just natural that some players would want to take profit on that, especially as we enter the holiday season. And not many fund managers will want to be caught in the volatility in December, especially as U.S. inflation data, the Fed rate decision next week, Bank of England, ECB are coming up. So next week is going to be a very significant week where we might see much more equity volatility.
Yeah, that'll that'll be interesting. Ksenia, good morning. But how much, given the strength of the rally that we saw, how much conviction was there behind that? Because I know that Citi strategists have been talking about this, saying there was only limited investor conviction behind the recent rally, as evidenced by some of the positioning flows that they look at.
That's right. So Citi is looking at the data from last week, and they're saying that despite the rally that we saw and that was before the data on Friday, the positioning was actually quite low. So the conviction in the rally was not that strong. So they're saying that most players actually maybe already took a step back and they're pausing and trying to see what the next data will bring. Again, the rally has been so strong. The S&P 500 moved above the 200-day moving average, which is a key tactical point. And of course, right there, you need to sometimes take a pause and see what the market will bring next.
Yeah, that tracks with Mike Wilson's view, who he took a look at that exceeding of the 200-day moving average and said, okay, we're sellers now. We're done with this rally. Ksenia, obviously, we're all looking ahead to next week and the Fed decision and CPI. Can we just declare the year over at that point, once that's over?
Yes, pretty much. I mean, all eyes are on that. But at the same time, just like I said, investors will not want to take bold bets in December. It's mainly CTAs and hedge funds that will be playing the market at a more intense pace. Generally, more institutional and mutual fund investors will already have closed most of their positions. They will want to cap this November rally, which was so extremely strong. It was one of the best months of this year. And they will want to go into the year end of the year with less volatility and not taking these bold decisions at this point.
Ksenia, thank you very much. Bloomberg's Ksenia Galushko with the latest on markets. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you find the market's live blog. This is Bloomberg.
Politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
You've got to explain this one to me. What does it mean? Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden is likely to announce that he's running for re-election after the Christmas and New Year's holidays. That's according to White House Chief of Staff Ron Klain. The president turned 80 last month and is already the oldest person ever to occupy the Oval Office. Bloomberg has learned that the U.S. has proposed selling Taiwan as many as 100 of its most advanced Patriot anti-aircraft missiles. The deal, along with radar and support equipment, is valued at $882 million. It's a move that would only add to tensions between the U.S. and China. The Biden administration is concerned that Beijing is becoming more aggressive toward Taiwan. PepsiCo reportedly is laying off hundreds of workers at the headquarters of its North American snacks and beverages division. According to the Wall Street Journal, the company has told employees the job cuts will let the company operate more efficiently. PepsiCo employs about 309,000 people worldwide. And the U.S. Federal Trade Commission is investigating several crypto firms over allegations their advertisements were deceptive or misleading. The agency enforces laws that require truth in advertising, including rules that individuals disclose when they have been paid for endorsements or reviews. The FTC is not releasing any details. And Matt, we continue to see stories developing like this, not just in the form of actual regulators taking action potentially against some of these crypto companies and people they hired as spokespeople, but also class action lawsuits, for example, in the case of athletes like Tom Brady and Steph Curry.
Yeah, a lot of celebrities went out and endorsed crypto, and now we're looking for someone to blame, right, after the collapse of FTX. They're wealthy and successful, so good candidates, I would say. Nonetheless, we're seeing more regulation come through, for example, in the UK, and we're seeing businesses, institutions, banks still interested in buying crypto assets like Goldman Sachs in a recent Reuters interview.
Yeah, perhaps we'll pick up on that theme when senior management at Goldman's interviewed by Bloomberg later on today. I'm sure we'll get further on that story. On the crypto front, it seems on advertising, Kaylee, it's the one area of enforcement that the UK has had more success with. When we speak to regulators here, that seems to be where enforcement has been easier around crypto because of the advertising regulations. But now we do see, as Matt says, the Treasury consulting shortly on a new regulatory regime that goes broader than that. So a lot to talk about when it comes to crypto, which I know you'll do in the next edition of your crypto show. Now, coming up next on this program, we'll talk to Holger Schmieding, Berenberg chief economist. That conversation next. This is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? The why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. European stocks head lower. The latest economic data has investors betting that the Fed's terminal rate will be higher than expected. US futures struggle for direction. A novel approach by the US and EU. They're considering new tariffs on Chinese steel and aluminum as part of their fight against carbon emissions. And voters in Georgia decide today what the United States Senate will look like for the next 2 years. They're going to the polls in a runoff election. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, a little bit of US politics to talk about later in the program to distract us. But in terms of the market performance, the Fed front and center, and US equity markets, as we said in our headlines, struggle for direction a little this morning.
Yeah, absolutely. I mean, we saw markets, U.S. futures gaining earlier this morning after the big drops yesterday in the cash trade. They have now turned around and are falling. We're looking at S&P futures down about 0.2% now. Remember, the market closed yesterday down 1.8% on the S&P and almost 2% on the NASDAQ. So we had a big sell-off after that positive ISM services number. Maybe a lot of market participants think that all this good economic data coming out is going to be more ammunition for the Fed to raise rates further. And so now the markets are pricing in a terminal rate of about 5.25%. The Bloomberg U.S. Dollar Index gaining, but not much. You can see, actually, I should say unchanged right now. It's up only 0.03% at 1267, still far off the level of, I think, 1353 or something that we saw at its high. And investors and strategists that we talk to think there's more room for the dollar to drop. Right now, it's not doing that. If the dollar rises, of course, that's a headwind for risk assets. If it falls, that's a bit of a tailwind. NYMEX crude is coming down. We did see crude oil this morning earlier in the session rising as well. It has now turned around. NYMEX is off 1.5% to 75.82 a barrel. I believe Brent was up earlier and has turned around as well. And then Bitcoin still holding at 17,000. It had been for most of November at 16,000 after the collapse of FTX, but it's climbed up in recent days to about the $17,000 mark, and it's holding steady at that level. Kaylee, what do you see in terms of the pre-market movers?
Well, there's not that much in terms of pre-market movers, which kind of speaks to the quietness and indecision we are seeing in the U.S. equity market this morning. The one real exception is GitLab, which is higher by about 18% in pre-market after reporting results after the bell yesterday. Beat and raised quarter. The outlook coming in ahead of expectations. Analysts really positive on the execution and resilience of this company, even in the face of an IT spending slowdown. So that giving a nice lift to that stock. But for others, we are seeing them come off of the pre-market highs, but the highs even weren't that high. The likes of Apple and Amazon were up about 0.5%. Now they're only up about 0.1%. And Tesla, one to keep an eye on as well. Remember, this stock fell more than 6% yesterday, Anna, after that Bloomberg scoop that they are looking to cut production at the Shanghai factory from as much as 20% from full capacity because of the demand issues in China. So that may be still creating a bit of a wishy-washy drag on the stock because Tesla right now is very little change in pre-market.
Yeah, little change. Just adding that China story to the to-do list of the CEO, who is a busy man, as we know these days. This is what we see on European stocks then, Kaylee. We're down by 0.6% on the Stocks Europe 600. Nearly all sectors actually in negative territory. So it's quite broad-based, this selling that we're seeing. And it does reflect yesterday's story around the Fed, but we'll see whether that has further legs into the US session later. Changing expectations, a revisit of the expectations around the Fed and the terminal rate based on that stronger data out of the US. The utilities sector is one that wasn't doing too badly earlier on. It outperforms, but not by much. Natural gas prices in focus, 134 euros per megawatt hour. And this is all to do with the weather. We've just been looking at some of the most recent data, forecasts around the weather for the next couple of weeks, and which suggests that an Arctic blast is on its way to Europe. And we know that that could make life difficult for people who are trying to afford those energy bills, and indeed for businesses trying to afford those energy bills. We'll also keep an eye on the South African 10-year yield. We heard from Fitch yesterday saying that all of the political turmoil, Matt, that we're seeing in South Africa as the president there is fighting for his political survival, all of that is adding up to the uncertainty around policy making in South Africa.
All right, interesting story to say the least. We'll continue to follow that. Let's get back, though, to the markets and the economy. Joining us now is Holger Schmieding, Berenberg chief economist. And Holger, it's interesting. We continue to see strong news in the labor market for the U.S. In terms of the ISM Services Index yesterday, a big beat. And that drives market participants to calculate a higher terminal rate for the Fed. What are you expecting from the world's most important central bank?
Well, first of all, we expect them to slow down the pace of rate hikes. That is 50 basis points in December. And then we'll see early next year how the data shape up. We currently look for a terminal rate of 5%, but it is, of course, possible that it could be slightly higher. All in all, I would say the recent news flow has not been really negative. On the one hand, we have inflation where we had a positive, somewhat lower than expected print with some special factors. Now we see for the US hard data that the economy and survey data is holding up a bit better than expected. All in all, I would say that is not a negative combination.
Okay, Holger, good morning to you. Did you see any cracks? And I don't want to be the one who's looking for the bad news in the good data, but I know that many policymakers are, because there's a focus on just whether the Fed can weaken the labour market a little bit. Are you seeing any cracks in the labour market story? Because some guests point to some areas of the data that look a little bit weaker.
It's absolutely right. The major point about the US labor market is that at the moment we are getting quite a lot of conflicting data between the household survey and the establishment survey. And you can point to this or that and say, oh, this is still a very strong labor market, or at least a strong labor market. And you can say, oh, look, it's weakening. I would say we should take roughly an average of the data flow, including the job openings. And what it does suggest is that the US labor market is softening, but softening only gradually. And we'll have to see early next year, probably in February, whether that softening that we are seeing is pronounced enough to dampen concerns at the Fed about wage inflation, and hence for the Fed to call it that's it for now at 5%, or whether they want to go a little higher. Still, going a little higher if the economy is holding up a bit better than expected should also not be such a great negative.
Holger, back into the European story, if I could, for a moment. We're currently dealing, of course, with high inflation levels, and that's the battle, and fears about a recession in Europe, and perhaps we're already there. But looking back to the pandemic, we're still dealing also with the legacy of plans that were put in place around the pandemic. A German constitutional court today giving its backing to the next generation EU pandemic funding, which some call joint debt raising around the EU. Others say, no, it isn't quite. And you grimace at that description. How significant is it that the German court has come to this conclusion? What does it matter for Europe?
First of all, it of course is joint debt issuance. The second is the German court today let it pass, which is a big risk that has been avoided. In that sense, it's not really news. Few people expected the court to really stop this program. But the court also let it pass only with a lot of sort of reservations. It was not a clear bill of health for this joint issuance, which means the question whether after this temporary, somewhat limited and somewhat targeted program, there could be other joint EU programs financed by joint debt. That, from the German point of view, remains a very open question. It's still highly questionable.
Okay, difficult to say. Kaylee?
Holger, while we're talking about Europe and the comparison with the U.S., 2022 has been a year in which central banks, including the ECB and the Federal Reserve, are all moving in tandem. How much could we see that diverge in the year ahead?
Well, upon the start of the year, we'll probably still see the Fed and the ECB and other central banks hiking rates to, say, 3% for the main refi at the ECB, 5% or slightly above for the Fed. But then over the course of the year, the picture could change. The European recession is very different. It's a response to sky-high energy prices. It's a response to anxiety about the winter. Once we've made it through the winter without Russian gas or with very little Russian gas, once we've made it through, I think that in Europe, the economic outlook will improve significantly, and we are hoping for a V-shaped rebound of the economy after a winter recession. In the US, the economy is slowing down gradually, and maybe in a mild recession, say by spring next year. In response to the US mild recession, the Fed may then cut and probably will cut interest rates from possibly September next year onwards, whereas the ECB, with the economy by that time in the V-shaped rebound from the recession, probably staying on hold. So we expect the gap between Fed rates and ECB rates to narrow late next year and in 2024, which of course would also support the euro.
Interesting. So you think the Fed is going to pivot back in the easing direction first. How much could China throw a wrench in that entire thesis you just outlined, Holger?
Probably not much. Of course, if something very dramatic were to happen in China, it would matter. But the balance between a slow, very slow easing of COVID restrictions, a bit more of stimulus, probably means that China has a rocky, wobbly winter. But this winter, we're going to have the European recession anyway. But then probably with more vaccination in China, with a further easing of COVID restrictions once the winter is over and the weather gets better, I would expect the Chinese economy to return to something approaching normal, and normal means around 4% growth from spring next year onwards. And in that sense, China will probably neither be a big help nor a big hindrance to global economic performance. No big hindrance because by that time we should have sorted out most of the legacy supply chain issues.
What do you make of the trade slowdown that we're tracking, Holger? It seems like as we approach Christmas, we really should see a pickup in shipping. We really should see a pickup in cross-border trade, but it isn't happening even as we come out of this pandemic and prepare for a holiday season. Why is that?
Well, seasonal factors, of course, suggest there should be or should have been a pickup in the run-up to Thanksgiving and the Christmas holiday. But as we speak, the European economy has probably descended into a bit of a recession, the winter recession, the Putin recession, and that likely offsets the other factor on trade. So I wouldn't expect global trade to do well over the next few months. There is more likely to be some bad news on global trade, especially early next year, before over the course of next year, from spring or at least by summer onwards, it should then get finally better.
Okay, after we've got through the cold weather, Holger, thank you very much. Holger Schmieding joining us there from Berenberg. Coming up later today, an exclusive interview with the Goldman Sachs CEO, David Solomon, live from their financial services conference. We've seen reports this morning from other media around crypto aspirations, so we'll certainly get that into the conversation. 8 a.m. in New York, 1 p.m. in London. This is Bloomberg.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality, and that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. The cruise industry shut down during COVID. Now, CFO Naftali Holtz has Royal Caribbean full speed ahead.
Our goal is to get back to the balance sheet we had. This business is very resilient.
Watch Chief Future Officer, Wednesday on Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, $65 trillion. That is the size of the off-balance sheet debt pile that the Bank of International Settlements, the BIS, is warning about, calling it a blind spot in global finance. Let's get the details from Bloomberg's markets editor, Valerie Teitel, who joins us now on set here in London. Valerie, good morning to you. So explain this to us. Why does this off-balance sheet debt pile exist?
Yeah, so this off-balance sheet debt pile, it's specifically focused in pockets of the market, what we call non-financial institutions. Those are things like pension funds, life insurers, for example, what we call non-banks. And they use currency swaps and FX forwards and able to hedge their portfolios and fund their positions. And there are also things like international corporations who raise money in dollars. They need to hedge that back into local currencies. They also use these things like FX swaps. All of this is treated off balance sheet, which means there really is no regulatory oversight in it.
Yeah, that sounds dangerous. So what do regulators like the Fed do about it?
Yeah, so the issue is that the size of this off-balance sheet debt is quite large. This piece from the Bank of International Settlement puts it at $65 trillion.
That number sounds almost made up, Valerie. I mean, what can total $65 trillion?
Yeah, that's 2.5 times the total U.S. Treasury market, Matt. But not only that, the scope of it, nearly half of it is outside the U.S. And then the maturities. They note that the FX swaps, of the maturities in the FX swaps, 70% mature in 1 week, 30% mature overnight, which means when there's a big run on dollar liquidity, you have these corporations, these non-bank entities really grasping for dollars, and it comes down to such short maturity assets that they're trying to roll over.
So Valerie, what are potential solutions? Did the paper put anything forward?
You know, it really didn't. It's trying to push the conversation forward. I think what happened in the UK with the UK's pension situation, the blow up there, that the Bank of England had to step in and help, really put an eye on this. And I think the Bank of International Settlements really wants to have a broader discussion with other central banks on how can we further identify these pockets of weakness. They put it down to they really want to know where the geographies are. And to me, that says they want to know what currencies people are borrowing dollars against to know where there's weaknesses are. You know, we can look back in the 90s, the Asian financial crisis was really ignited by the fact that there was a lot of dollar-denominated debt backed by Asian currencies, and when those currencies started to weaken, they had a very large problem rolling over their debt.
Absolutely, and every time we think about the strength of the dollar, we wonder where the vulnerabilities to that lie, in particular in cross-border debt. Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on that potential headache for regulators if they can get their heads around the size of the problem. Now, coming up on the program, we'll talk U.S. politics. Voters head to the polls again today in Georgia to decide the fate of the U.S. Senate. We're live from Atlanta next. This is Bloomberg.
do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up on this Tuesday. EU finance ministers are continuing their meeting in Brussels, plus EU and Western Balkans leaders are meeting in Albania for an EU summit on the bloc's expansion plans. Here in the U.S., we'll get some economic data, trade data crossing at 8:30 a.m. Eastern. And finally, in politics, voters are heading to the polls in Georgia for the Senate runoff between Democrat incumbent Raphael Warnock and Republican candidate Herschel Walker. The polls open at 7 a.m. Eastern, so just about an hour from now. Joining us with more on what to expect from the runoff election is Christian Hall. He is Bloomberg politics reporter, joining us early morning from Atlanta. And Zach Cohen, our Bloomberg government and Congress reporter, is up early for us in D.C. So, Christian, if we could just start with you. Obviously, in-person voting taking place today beginning in an hour, but I understand there has been a lot of early voting. What does the latest polling indicate about how tight this race is and ultimately which way it's going to go?
It's a really close race. But the signs of early voting, high levels of early voting, show that this is a really exciting race. There's a lot on the line here. 2021 and 2022, this runoff election is very different than past Georgia runoff elections. It's a big day.
So, Zach, tell us why this matters. You know, from the Democrats' perspective, they already, with a 50-50 tie and the vice president's vote, control the Senate. Why does 51 make a big difference?
You're right. Unlike the January 5th runoff in 2021 that decided the fate of the Senate in Georgia, being, no stranger to these runoff elections, this particular one actually isn't going to determine control of the Senate. What it does do is sort of give Democrats potentially a little bit of wiggle room. If Senator Raphael Warnock is reelected, they would have 51 seats as opposed to the 50-seat majority that they have now. That gives them majority on committees. That gives them a little more leeway on procedural votes. If they lose a vote on a nominee, then that nominee can still get through. Democrats are very aware of the tenuous nature of a narrow majority in the Senate, as you've seen over the last 2 years, and certainly a Warnock victory would give them a little more flexibility, whereas a Walker victory, if the Republicans end up flipping this seat, the Senate would stay tied 50-50 because Democrats picked up the Pennsylvania Senate seat with the election of John Fetterman.
So 51 is very different from 50, as you described there, Zach. Christian, in terms of what is deciding this particular race, is it the same national themes that we were talking about last month, or is there a sort of local dimension to this we need to be aware of?
Well, I think, national issues like the economy are still, front of mind for voters. But This one is a little bit different as well locally. I think some of the scandals from Herschel Walker's campaign will be top of mind for voters. I also think that the Trump factor is a part of this decision for voters. Trump has been seen distancing himself a little bit from Herschel Walker in this race. So there are a lot of factors that are going to be impacting voter turnout today.
And on the subject of that turnout, Christian, what will you be watching in terms of demographics that could be a tell potentially on 2024 as well?
Yes, absolutely. Herschel Walker and Raphael Warnock are running today. I think Warnock is really going to be trying to turn out his base, turn out black voters. Georgia has traditionally been a Republican bastion, but due to demographic changes and population growth, we've seen black voters becoming a very powerful voting bloc in the state of Georgia. So I think that this can be somewhat of a projection of what can happen in 2024 in the state.
Zach, how soon are we gonna know who's got the edge? Are there gonna be exit polls here we can turn to? Will there be a live blog we can follow? Where do we get the info?
Well, certainly if it's a really close race, it's unlikely that we would get a result tonight. As we've seen in some of these other really close races in places like Nevada and Arizona, it took days to count the votes. Georgia counts its votes a little bit more quickly, even in the 2021 runoff between Raphael Warnock and the former Republican Senator Kelly Loeffler. There were results within a day, January 6, 2021, a day, obviously, that folks will remember for very different reasons. So we could have results sometime overnight, maybe early the next morning. It really does depend on the margin. If one candidate wins by a very large margin, then certainly we'll know the result much quicker. If it's a really close race, as Christian and I expect, it could take a little longer to count all those votes before people really know who the ultimate victor is.
And Christian, you mentioned the Trump factor. Clearly, his role in the elections that we saw last month, much scrutinized. I wonder if he's playing a similar role in this particular runoff, or if his tactics have changed a little, given what he learned last time around and what he plans for 2024.
Well, I think he's learned a little bit recently that his role could possibly negatively impact this race. Yesterday, he hosted a telephone rally for Walker rather than having an in-person event, kind of getting away from the campaign too closely. I think a lot of GOP strategists that I've spoken to have said that he's been urged by the party within to not get too close to this race.
Okay, thanks to both of you. Really good to get your perspectives on the program. Bloomberg's Christian Hall in Atlanta with the mood on the ground and what's at stake there. Zach Cohen in D.C. with what more broadly is at stake, of course. That is it for Early Edition. Surveillance is ahead. Tom, John and Lisa will be with you. We'll be hearing from David Solomon, Goldman Sachs chairman and CEO. No doubt has a lot of interesting things to say as we head into 2023 about capital markets, about the economy and the Fed. This is Bloomberg.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, today on Bloomberg.
This excess savings conversation, from our perspective, is starting to run out.
The rocket fuel for consumer spending is coming in a dramatically slower fashion going forward.
To say that we've already drawn it down, we're headed into a liquidity crisis, I think is a little bit premature.
We're going to have to see growth weaker for central banks to hit their targets, and that's not yet reflected in earnings.
We've got shoes to drop that we have to wait for in 2023. It's too early. We haven't seen the capitulation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Bremo's back. Week begins on a Tuesday. Have you noticed that, TK?
She had all four stores at the corner of 5th Avenue and 57th Street. You make the circle there.
3-day weekends for Lisa.
Some started Bulgaria, others started
yesterday.
Tiffany.
You're projecting, Tom.
Great to have you back.
Thank you.
Live from New York City this morning. Good morning with Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures right now unchanged on the S&P 500. TK, we need to work out, is this economy speeding up or slowing down?
Yeah, I think that's a conundrum here, and it's in the literature this morning. It's in the market this morning as well. And I'm sorry, the Fed's, their head is spinning here. We've got, you got the global inflation we'll talk about in a moment with OECD coming out moments ago. The domestic inflation story is a mystery of the path down to what, John? And a lot of it has to do with, are we slowing or not?
The growth story is a mystery for me, Bramo. If you think about Friday, upside surprise on payrolls, the ISM yesterday picking up in a way that I don't think many people anticipated.
I didn't see it. Yeah.
Neil Dutter of Renmac has been all over this for the last couple of weeks, and he had more to say yesterday.
And we're seeing even the likes of Paul Krugman come out and say, when the facts change, I change. This shows an acceleration that we were not expecting. You're hearing that in a lot of different economic corners. I was looking at this one data point, that core goods account for just more than 1/5 of the consumer price index. So core goods are disinflating. The rest of the world, the services world, not so much.
Neil Dutter says this, Tom, the slowdown story is becoming increasingly stale. What do you make of that going into year end?
Well, I'm in the camp with Neil, where I have the optimism of a Neil Dutter. Jim Glassman's on the same page over at JP Morgan, and many, many others as well. And I just think we staggered, John, from every report, and we're going up to an inflation report, again, witness OECD today, that is frankly more important than the jobs report we just had.
CPI, December 13th, and the Federal Reserve, December 14th. Need to keep an eye on layoffs as well. The latest coming from Dow Jones, the Wall Street Journal, indicating that PepsiCo will lay off hundreds, Lisa, from the headquarters. So it's the headquarters where we're going to see the hit potentially from that company, and not the first, and likely won't be the last in the next couple of months.
There was another Wall Street Journal story in the past couple of weeks talking about how the layoffs have come much more in the white collar space than in the blue collar space, that the people who actually do the work, the real economy, is still necessary in a way that perhaps some of the office jobs are not.
One of the researchers over the night, John, very quickly here, Tom Porcelli at RBC Capital Markets, and you know my theme of the x-axis?
Sure.
The timing. Porcelli is heated. He's expert on wage dynamics. He's heated. The word he uses is grind. The labor deterioration grind is going to take forever to get where Chairman Powell wants to be.
The so-called rebalancing that his Fed desires.
Out.
further out. Let's get the price action for you. Whip through things briefly. The equity market shaping up as follows on the S&P 500. Unchanged, futures going nowhere. Yesterday, biggest one-day loss on the S&P in about a month. Mike Wilson, can we please have your crystal ball?
Yeah.
Over at Morgan Stanley.
What was the why on the loss? Was it the ISM?
ISM came out hot.
Yeah.
Yields blasted higher. We got a move on two-year yields that we didn't get on Friday after payrolls, and the curve inversion, deepest curve inversion, going back to the early 1980s.
It's back there again. We came back negative 80 basis points. Is it about global growth with West Texas Intermediate well under $80, $76.15 a barrel?
$76 right now. And Lisa, just briefly, your 10-year, 356.25.
I do love it that Mike Wilson comes out and says it's over and the market tanks. It's almost like he does kind of have this telepathic view into the markets. Today, what we're looking at, Georgia Senate's runoff election with Democrat Raphael Warnock facing off with Republican Herschel Walker. Very curious to see the outcome of this, in part because of the fact that people view it as a referendum on the Trump-backed candidate. Also, because it merely marks the difference, not necessarily of the majority in the Senate, but a 51-49 mix, which could be more significant for policy. Today, there is the Goldman Sachs Financial Services Conference. Sonali Basak is going to be speaking with the Goldman Sachs CEO David Solomon. That is going to be in about 2 hours' time. Also, CEO Brian Moynihan later in the morning. And President Biden is visiting Taiwan Semiconductor Manufacturing Company's construction site in Phoenix. This, to me, is actually going to be really interesting. And we'll be speaking with Brian Deese, the White House economic advisor, in about an hour and 15 minutes. But, John, to me, there's a question about how sustainable this move can be and what this ignites overseas with European allies if so much of the jobs that we're looking for that are critical to the supply chain are really being encouraged to move to the U.S.
I'm thinking more about China as well. Tim Cook's on that trip, right, of Apple. That's going to be interesting.
How much can they actually move away from China, given their dependence not only on the supply side, but also the demand side?
Jane Foley joins us now, I'm pleased to say, to kick off our coverage this morning, the head of FX strategy at Rabobank out of London. Jane, can I start with a question that I posed to Tom moments ago? Is this U.S. economy picking up or slowing down?
You know, I think the only thing that we can be sure about is that this is going to be a really choppy ride. And I think there are different dynamics in this particularly slowdown, shall we say, than in other years. And that is because, of course, the labour market dynamics. And you've already spoken about it. You know, if we look at the OECD data, almost every single country in the OECD have got labour market shortages. And this is in part a demographic issue. You know, if we look, for instance, at the UK, already almost 20% of us are over the age of 65. That dynamic will be there in the US in 2030. There's going to be a shortage of labour. And when we talk about the onshoring that you've been mentioning, if we talk about our critical industries in perhaps pharmaceutical or in food, energy, these sorts of things, it's going to be very difficult to onshore without coming across these labour market shortages. And that means that it's very likely that inflation is going to be persistent on the core level for some time, and therefore you've got this issue of Fed interest rates, irrespective of whether or not the peak is 5% or 5.25%, but probably staying at that level for some time. And then, given that the equity market has rallied for 2 months, it's going to be sensitive to that sort of information that leads it to assume that Fed rates could be higher for longer.
Jane, OECD out with their report. It's always an interesting report, but ever more interesting now. 18 of 38 OECD countries are enjoying double-digit inflation. How does your world change or adapt to that? Do you become more dollar-centric in your analysis? Are there certain currency pairs you look at when we have this amazingly persistent inflation?
Well, you know, persistent inflation, that we can talk about OECD and we can talk about labour market shortages across the board, but I think Europe is where inflation really is quite dangerous. And this is because at the moment, you know, we've seen the euro rallying, we've seen a lot of relief. Energy or gas storage units are pretty full, even though we've begun to go into this cold snap now. And people are optimistic about we get through this winter and the Eurozone economy is going to be okay. We don't have that view because, you know, particularly if you have have a China reopening, say next spring or next summer, there's going to be a lot more competition for that LNG, for that gas, for Europe trying to fill up its gas storage units for winter 2023 without using supplies from Russia. That's going to be really quite difficult, and we think actually winter 2023 is going to be pretty tough for Europe. So actually, if we're looking at other currency pairs, for instance, I would look at the Aussie rather than outperforming the euro going into, say, a 6-month or a 12-month view, because I think Europe is going to be really very sensitive to persistent inflation over the medium term.
And certainly Australia is getting a bit of a boost today after the 25 basis point rate hike overnight by the central bank there. Just want to build on what you're talking about with Europe. There was a story in the Financial Times today talking about the reliance of particularly Germany and German manufacturing on Russia for natural gas. If some of the worst case scenarios come to pass with respect to a cold winter and not having some sort of additional LNG supplier, where do you see that taking the euro in and of itself, with Germany's main industry flat on its back?
Well, again, it very much depends on what happens going into winter 2023. And we'll hear a lot more about that, I think, in the summer of next year. But to be honest, I think there's a risk still that we could see below parity again in that sort of time horizon, because I think the market's had this respite for Europe. We've had a warmer period. We know that the gas storage units are full for now. The market is optimistic. Oh, yeah, we'll get through this winter and things will look fine. But actually, winter 2023 is looming out there. It's a concern. We have a lot of commentary already about the deindustrialization of Germany, which is a very frightening thought. And perhaps you might not want to use that term because it is so frightening, but you can certainly look at Germany's business model and you can see big chemical manufacturers, pulp manufacturers, paper manufacturers, glass manufacturers all having moved or curtailed operations in Germany already. And that's not just by looking at this winter, that's because they're looking ahead to what might be for the next couple of winters too. So I think Europe is still in a very dangerous position, even though the outlook for now appears to have brightened.
Jane, do you think we've underplayed, when it comes to the dollar trade, underplayed how important the other side of the currency pair has been through 2022? I'm thinking about Europe and the energy crisis. I look at sterling and the policy issues. I look at China and COVID zero. You can really take your pick, Jane. I wonder if we're still underplaying that going into 23.
I think quite likely, because there's two parts of the dollar trade, and the first is the interest rate differential and the focus on the Fed and peak inflation, etc. But the other is a lot of the geopolitical effects, the safe haven demand for the US dollar. And if we do have real concerns next summer, so China's reopening, big demand for LNG prices going up, Europe really facing another difficult winter in 2023. There's going to be the market thinking, well, you know what, maybe the dollar is a better trade because of safe haven, and that is something which could mean, again, certainly that we're going to have a very choppy picture of this peak dollar, but it could be quite a lengthy period of peak dollar, as this choppiness really plays out perhaps for some months.
Hey, Jane, this was great. Jane Foley out of London, over at Rabobank on the US dollar and foreign exchange. Lisa, I think this is really important stuff. When it comes to the dollar, we focused a lot on this massive rate hiking cycle of this Federal Reserve through 2022. But it's the other side of the currency pair that's really dominated things, whether it's sterling and the policy issues of the last couple of months, whether it's Europe, the energy crisis, China and COVID zero, the BOJ and burying its head in the sand as everybody hikes interest rates. There's a lot going on outside of the US dollar.
But everybody basically makes the narrative that the US is just doing so well, so therefore it's because of potential Federal Reserve hikes, which also is part of the story. You raise a great point, though, and if we do get that chop that Jane was just talking about, what does that do to some of the leverage that's put on with interest rate swaps and other issues? This is something that Bank of International Settlements has been looking
11 minutes into the show, and we've not mentioned the World Cup, Tom.
Right now, well, we had Jane Foley on Rabobank, a great Dutch bank. Kan Nederlanden, Argentina, Verslaan.
Translate that.
Can Virgil van Dijk beat Messi?
I thought you were just going to say
Can the Netherlands take on Argentina?
What a head-to-head that's going to be, Tom.
I mean, those are two physical teams. They're like not the Brazilians. They're not this. They're not that.
Did you watch Brazil yesterday?
I enjoyed it.
Oh, it's a beautiful thing.
It's
45 minutes of just.
Do they play that way in the Premier League with all the footsie fancy ball thing? Do they do that?
The individual players?
Yeah.
Have you seen Anthony over at Manchester United?
No, I've not. Help me.
He's trying to.
He's trying.
And I think you see Vinny do that at Real, and Neymar do that at PSG.
Okay. Well, it's good. Scotty Moore is today with us today, or is she on life support?
No idea. Spain a little bit later this morning. Morocco, 10 a.m. Eastern Time. That's after the Open on Bloomberg TV. Coming up a little bit later, Amy Wu Silverman of RBC coming up in the next hour. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. In China, a COVID outbreak that began last month appears to be tailing off. The nation reported a little more than 276,000 new cases on Monday. Infections have fallen each of the last 8 days. At the same time, there's been a pullback in the sweeping testing regime in major cities. Officials are seeking a more targeted method. Bloomberg's learned that the U.S. and the European Union are considering new tariffs on Chinese steel and aluminum. It would be part of a bid to fight carbon emissions and global overcapacity. It's a novel approach. The U.S. and the EU would use tariffs usually employed in trade disputes to advance their climate agenda. President Biden is likely to announce that he's running for re-election after the Christmas and New Year's holiday. That's according to White House Chief of Staff Ron Klain. The president turned 80 last month and is already the oldest person ever to occupy the Oval Office. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, Bloomberg is live from the Goldman Sachs U.S. Financial Services Conference in New York City, speaking with industry leaders, including an exclusive interview with David Solomon. Bloomberg Television and Radio, your global business authority.
I'm glad we're dancing tonight, but don't dance too much. Don't spike the football before we get it into the end zone. We are going to win.
A vote for me is a vote for Georgia values. And it also is going to give you a voice in Washington because you hadn't had it yet.
Another runoff in Georgia. Amazing how consequential this was, Tom. What, 18, 19, 20 months ago, and now less so. Now less so down in Georgia over the next 24 hours.
We're here. It's alone. It's a complete focus today for all of political Washington. And John, I would go back 40 or 50 years to the giant John McPhee, who changed nonfiction writing in America. It wasn't his first book, writing for the New Yorker, but it had a lot to do when he wrote an essay on Georgia from south to north. and particularly a foreigner like me up in the north or a foreigner like Joe Matthew, you say, do we really know Georgia? And I think Georgia's hugely misunderstood.
We'll pick up on this story in just a moment. Just want to get you up to speed on the price action. If you are just tuning in this Tuesday morning, good morning to you all. Equity futures are just slightly lower, negative by just 0.05%. No real drama here. The drama was yesterday. Great data in America, again, an upside surprise, and that drove equities lower and yields much higher, specifically at the front end of the yield curve. So the 2-year blasting out, and a 10-year still around 356. So you've got that curve inversion, Tom, just deeper curve inversion. Negative 80-something basis points at a close yesterday, and levels we haven't seen since the early 1980s.
Ian Lingen publishes a possibility of a negative 100 basis point
over at BMO
inversion.
100.
Like Volcker level.
Wow.
That's a wild statistic as well. He's truly a pro at it. Let's dive into the political moment in the state of Georgia. We can do that with someone steeped in the warfare of Massachusetts politics. Joseph Matthew joins us this morning in Atlanta, trying to take Atlanta Braves players back over to the Boston Red Sox. Joe, I look at this, and I'm going to go to Jason Koo in the New York Times with some great graphics of how volatile Georgia has been. And the heart and soul of it is the northern suburbs of Atlanta, their vacillation this way and that. Before this election, one day before the election, those key 80-some precincts, how are they vacillating?
Well, we're just about to find out here. It does appear that they are vacillating towards the incumbent, Senator Raphael Warnock, who I will remind you won the election just a month ago. 37,000 vote victory, but they didn't get to 50%, so that's why we're doing this runoff. But as he says, he has now run for this job 5 times. He's won it 4 times. And he's going up for another one here, but your point is correct. This race will likely be decided in the Atlanta suburbs. This is really, we're drilling down here to 200,000 voters. That's it. Who split the ticket 1 month ago, voted for Brian Kemp, but did not vote for Herschel Walker, the Republican. Those are the voters who are going to decide whether Raphael Warnock stays in Washington or Herschel Walker becomes the next senator from Georgia here. And he's feeling pretty good. I was with Warnock at that rally last night. We just heard from Jeezy was the entertainment. People were really feeling it. It was pouring rain, and that's what I'm going to point you guys to. You should normally be able to see Peachtree Street behind me here as I broadcast from the Bloomberg Bureau in Atlanta. But guys, it's pouring rain. There is so much fog you can't see the tops of the buildings. And if this race does come down to turnout, as we do believe, the weather could be the biggest story today.
What is the early voting? Is it a factor here like it is for the first Tuesday of any given November?
It's a massive factor. They set a record. About 2 million people voted early in this race. We know, based on the areas they came from, that they're from democratically friendly strongholds. We know that a lot of black voters voted early this time. And so Herschel Walker's been taking his bus up around the northern reaches of Georgia into the rural areas to try to pick off white, independent, and Republican voters he thinks might be able to make the difference in this race. This has a lot less to do with the individuals in some cases as it does the party message. You want somebody to vote with Joe Biden or Mitch McConnell? There's your choice.
And Joe, talking of that, what is the importance of 51 votes for the Democrats in the Senate versus just 50-50? How much more, what policies could they potentially go after that they couldn't with just an even split?
Well, it gives them controls of the committees, and that's really what we're talking about here. Instead of having to force a power-sharing agreement with Republicans, that gives them control of the committees. And remember, we're talking about the Senate. This is where judges are confirmed. This is where nominations are sent by the administration, right? When Joe Biden goes to fill out the rest of his cabinet next year, when I'm assuming we get some departures, it's the Senate that's going to deal with that. Incredibly important here as we see likely Kevin McCarthy take the gavel with a Republican majority in the House in a couple of weeks.
Emery Horton joins us as well, our chief Washington correspondent, and we're thrilled she could be with us today in Washington. Emery, what is the best outcome here for the president? I mean, obviously it's a Warnock effort. There's no question about that, but there's got to be a body language to it. What is the best outcome?
That is the best outcome. And I think, as Joe really outlined, this obviously isn't a need to have for the Democrats, but it's certainly a nice to have when it comes to having that advance ability on committees to be able to make sure that they're getting their individuals and candidates through. But also the fact that you have to look at 2024, which we heard from Ron Klain last night, that he expects the president to make an announcement. That announcement is to run following the holidays. He's obviously going to be talking with his family, as he did in Nantucket over Thanksgiving. But 2024, the Republicans have to defend 10 seats. The Democrats have to defend 23 seats. It'll be really crucial to have this Georgia seat for 6 years if they're able to grab it this term.
Anne-Marie, you mentioned Ron Klain, the White House Chief of Staff, talking about Joe Biden probably announcing his likely run after the holidays. Is there any pushback? Is it mounting for him to anoint a sort of successor within the Democratic Party, given where he is in the polls, given where he is in his career?
Well, listen, coming off the midterm elections, Biden definitely has a boost within his own party with the fact that everyone said this was going to be a red wave. It was not. They even picked up a seat. Potentially, they're going to end up picking up another seat in Georgia. And they lost the House, but it was very, very slim. So this really keeps Republicans in check in terms of what Biden wants to do. There's obviously they're going to have to work in a bipartisan way, but this was most certainly the better outcome that many were predicted for the president, which is why also he feels like he has this momentum to be able to run. Also, former President Donald Trump already made his announcement. And Biden said he got into this race originally because he thought he was the only person who could beat Trump. And likely he will continue that mantra going into 2024. But yes, obviously, people in the Democratic Party are thinking this. He was already the oldest U.S. president. He recently turned 80 just a few weekends ago. So they are obviously thinking about where is the bench? Who is going to be next to lead this party into the future?
AMH, down in Washington. Anne-Marie, thank you. Let's pick up on those comments from Ron Klain, Tom, speaking to the Wall Street Journal's CEO Council. I expect the decision will be to do it. This is basically a pre-announcement of the announcement, isn't it?
It certainly looks
and not
like
a shocker to a lot of people. I think this was widely anticipated.
Still, when Anne-Marie Horton says the word 80, I don't care who it is. I'm in shock. How did we get here, I guess is my answer. And frankly, I thought the way Speaker Pelosi stepped aside was with some grace, and the gentleman from Maryland, Steny Hoyer, did the same thing. And, you know, there was a constructive ballet in the House, but when did we become a gerontocracy?
You asked the question. Can you help us answer it?
No.
What's your take on it?
I just don't know. I honestly, you know, I'd lean on experts here, Michael Beschloss and others, but I just don't have an answer for the shock of hearing Anne-Marie Horton use the 80 word.
It's consistency right now. How much is this really just a moment where he's trying to keep consistency so he can get some agenda through before they figure out what to do? Because if he announced now, 2 years out, I'm not going to run again. How much does that torpedo his agenda and his leadership?
What's the equivalent in Britain? This is a nostalgia back to another generation.
Well, we don't have one. We have a very young Prime Minister.
Even Tony Blair and Gordon Brown are not on the edge of... John Major? Is it like if
right now, their age? Yeah, sure. They're nowhere near that right now.
They're nowhere near that right now, but John Major maybe approaches that. Do we need John Major to come back and run?
I don't know if anyone wants that, even at the Conservative Party.
But that's the equivalent here, where we...
I think we're underplaying this. This president seriously believes that if Donald Trump is the candidate for the Republican Party, that he can beat him. Bottom line, he seriously believes that.
Yes, I think...
Based on the way he communicates, he truly, seriously believes that.
I think so. I can't disagree.
Coming up, Tony Dwyer of Canaccord Genuity on this equity market. It's the bear market rally over. Tony's up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Tuesday morning, good morning to you. Equities going absolutely nowhere on the S&P 500, a break after the chaos of yesterday, if you want to call it chaos. That's what Bramo called it this morning when she walked in the studio. Tom, chaos.
Shocked.
And pleased she took the day
just
off.
was shocked she went that angle.
Futures unchanged on the S&P, on the Nasdaq up about 1/10%. Big day of losses yesterday, biggest one-day loss in about a month off the back of stronger than expected data in America. Economic output picking up if you're looking at the ISM services indicator. That meant two-year yields were picking up as well. Here's a snapshot of the bond market, 2s, 10s and 30s. Your two-year back to 436.64. Yields coming in a couple of basis points this morning on a two-year. On a 10-year, we're at 356.98. So we unwind some of that curve inversion. The curve just a little bit steeper, but still negative, Tom. Almost 80 basis points this morning.
Number one guy right on oil, Ed Morse, will join us later. John, just moments ago, oil dropping down again, right up, buttressed up on 75 handle. On oil, the low was November 28th, $73.60. To break down from there, we don't do chart opinions here, but I will simply state the chart is inelegant, to say the least.
I love that you say we don't do chart opinions.
We don't do chart. I'm not going to get into
you follow up with a chart opinion.
Analysis.
I'll say this about crude, Tom. It's interesting to see this pullback in crude at a time that we're seeing evidence every single day that slowly and incrementally China is making a shift away from COVID zero. Now, I say specifically slowly and incrementally because we have to look at the policy that we're seeing and the policy changes that are adapting day to day, week by week, and not anticipate this full reopening that may or may not materialize. The ultimate move that we've seen this week, I think, is to back away, Tom, from testing requirements. We saw that in Shanghai in the last couple of days. We're seeing it from Beijing this morning, just backing away slowly from testing requirements across major cities.
That'll be the news flow, but there's others, and one is the diesel price is clearing up in the Northeast. I mean, I saw a number of blurbs over the last 24 hours, which is where you get to a lower gallon of gas, a lower gallon of diesel, etc.
Lisa's been super focused on that over the last several weeks. In fact, Lisa, you were worried about it at one point. You still worried now?
Yeah, I am. I actually am very worried because the price action, you can come up with a narrative that makes sense, but we're seeing ships, tankers being backed up over in Turkey, trying to figure out this whole Russian gas cap, price cap, and what's going to happen with that. It's unclear to me. The narrative makes sense. The price action, less so.
Is there a narrative? It's
on
out
crude?
there. No, I think
On
in
the
general.
pullback?
Tony Dwyer is chief and narrative strategist at Canaccord.
Is that what his
Genuity.
title is?
That's what his title
official
is.
title.
He has been, seriously, folks, Anthony Dwyer has been a confirmed bull for years, wrapped around his singular call, which is if you don't have a recession, it's tough to go down. When the facts change, Mr. Dwyer changes, and he joins us with a short, taut outlook for next year. Tony, your outlook for next year is very un-Dwyer. Discuss.
Well, it was for this year too, Tom. Listen, we come up with great formulas and awesome quant programs and big words, but ultimately what it comes down to is you need money to buy things, do things, or invest in things. And the issue that we've had since last spring was when the Fed is tightening to the degree they are, It's restricting the amount of money that's out there. And yes, we were given a ridiculous amount of money during the just after the pandemic, but I don't know about your household. My household spends it. So I need new money to spend more money.
Right.
And that availability has just been dropping.
Well, I look at this, Tony, and you've got a turn in the year. I've never seen so many outlooks gaming out turns to a week or a day or an hour. How do you prosecute owning equities if the turn in the summer of 2023 is so opaque? How do you don't find a moment to jump into the market? How do you get into the market if you're more optimistic later on?
Well, despite being so cautious this year, there were two opportunities to have some pretty significant rallies. There was the summer rally, which came out of an extreme oversold condition and a bit too much pessimism. And then the same thing happened after what we called the fall, where you got this year-end rally. And remember, the year-end rally, there's a lot of historical precedent out there. Anytime that you've been up or down through the first 3 quarters of the year more than 20%, other than the great financial crisis, which I don't think we're in, each time you've been up a range between 8 to 12%. So we met that. So really, Tom, what it comes down to is every rally starts with an extreme oversold condition, every real intermediate term rally. And that's what we're expecting once we go back to the lows next year. It'll start as an extreme oversold rally, and it'll hopefully be kickstarted by a Fed that is not just taking their foot off the throat of the market, but is actually adding some air.
Tony, I love this. Basically, the market is so convinced that the market's going to be down for the first half and up for the second half, that they're just remaining all invested now and are going to ride the ship, which isn't going to lead to that sort of downturn in the first half. I mean, what's going to be the trigger? Some people talking about earnings coming out softer, yet what we've seen from companies isn't yet that.
Right, and that's it. Guys, it was 4 months ago that things are great. Used car prices, everything is great. And now there just, Lisa, hadn't been enough time for the Fed's actions to really enter into economic output. And that's so now we're starting to get it. The ISM's below 50. The household employment data is weak. You're starting to get the idea that bad news can become bad news. Up until now, we've been in the temporary sweet spot. It's what really caused the narrative for the year-end rally. You've been at a point where the Fed hiked rates quick enough that it slowed goods inflation. So we went from the pandemic, where I don't know about you guys, but in my household, Santa comes every day. It's on the front stoop. So we went from buying stuff to doing stuff. So the goods inflation has come down because of the transition of that plus the Fed. But when you look at the services inflation, Jerome Powell was very clear, and it was also evident in the payroll data last week. There's labor inflation, and that's likely not going to peak until at some point next year. So the sweet spot that had driven the rally was inflation's off peak. But the problem is you're not yet at the point where you have a recession. And that point, Lisa, to make a long-winded answer even longer, is when you get those earnings declines next year with an economic recession.
So basically, John, what I just heard is that we're going to hear Tony go home to his children and say, Santa Claus isn't coming today.
It sounds like Tony's unhappy with the amount of time that Santa has to visit them.
I'm already getting heat for
show up too.
Yeah, I'm getting heat already on Twitter for calling him a bull. The answer is Dwyer has been in this market and participated in this market, John and Lisa, forever when everybody else was scared stiff.
Well, and he's not alone. And this is really sort of the key question, and that's what you both are getting at, which is when do you get out and then when do you get back in, or do you just stay in, and does that actually prevent the market from going down? There was a study from Goldman Sachs showing that big investors have about $5 trillion hinging on a soft landing, even as more and more analysts say a soft landing is not in the picture anymore. Do you think that those are going to get, those are positions that are going to get slammed out? Positions in, for example, cyclical companies, positions, for example, that there's going to be some sort of softening in the rate cutting cycle much sooner?
At least everybody's jumping on the industrials. The time to do that was earlier this year when they were the industrials. It's funny, if you look at a chart, I know Tom doesn't use charts, but if you look at a chart on the industrials, they seem to peak just before a recession starts each cycle. So this is what's happening is typically